Contractor who wants to buy roofing is going to want to buy insulation and vice versa. So tons and tons of cross-selling, lots of synergy on the purchasing side. We have a lot of the same vendors that are vendors to both of us, and we have a lot of common customers. There's tons of integration and synergy to do here.
You said accretive. So how much does this accelerate your plan to what, $50 billion revenue?
Well, it's getting us there. We're getting closer and closer. So we'll be about $18 billion after the deal. We'll be over $2 billion of EBITDA, and we want to get to $50 billion of revenue, and we want to get to $7.5 billion of EBITDA. So look, 11 months ago, we had zero revenue, let alone profit, in building products. Zero, 11 months ago. You know, with this deal, we're going to be $18 billion of revenue and over $2 billion EBITDA. So we're moving and grooving.
What are the shorts getting wrong?
The shorts always get it wrong. It's a bad industry to be a short, though, because the market is generally bullish over time. So the odds are stacked against you. Look, anytime you do a deal, the stock usually goes down, particularly when there's a stock component. At first, we're not worried about today. We're focused on the medium and long term. I'm very confident about that.
And how many times, you've done this how many times? I mean, you've done something like 500 plus deals, right?
I've lost count, but in that amount, yeah.
Yeah, I mean, what
range.
where does this one stand out in terms of, similarity to some of the other ones and strategy and all that, or is this just classic Brad Jacobs?
It's classic.
Playbook?
It's classic. It's very traditional. That's why we picked it. It's something that we have our arms around. It's something we can do. It's something we feel very comfortable with. I'm very optimistic about this one.
Walk, chew gum, pad head,
yes,
and juggle.
At the same time.
At the same time.
Yes, Carl.
Yeah, at the same time, though, that residential construction is kind of sluggish, right?
That's actually a positive thing from an acquirer's point of view, because there's not euphoria in the stocks and crazy multiples.
Okay, well, Brad, thank you very much for joining us to talk through it.
My pleasure.
We always appreciate it. That's Brad Jacobs, Chair and CEO of QXO, on the back of the big deal.
When we come back this morning, one of the street's top strategists on why he says the market is showing its first signs of legitimate momentum in more than a year, plus two names in the travel sector on his breakout list. That's next.
And speaking of travel, watching the airlines today, American saying it's not interested in any discussions regarding a merger with United. Right now, shares of both are down. American's down more. Stay with us.
Alrighty, team. We are back. Had a little bit of technical difficulties. I didn't realize that we weren't on YouTube anymore. Went on ahead and fixed that. Got us back on here. I want to thank you all for tuning in. Appreciate you. Game plan is still intact. Told you guys that I'm looking for a call above the 710 area. Looking for 710.5. I have an alarm there at the 710.2. Already set and in place, and looking for a put below the 705. So both alarms are still in place. Still looking for that first potential red day, and now I like it even more because on the daily chart we do now officially have a tail, and if we start eating up that tail, that's going to be a really good indication that we could potentially head down for some more potential downside. Again, going to take place at the 706. So 706 really has me curious and interested and ready to get in. I'm actually going to move my alarm up to the 706 now. Okay, just to let me know if the market does decide to come back down that low, and if it does, we'll be continuing on this potential red day. What I don't like is the volume right now. We had one of the largest volume candles at the open, and then that was followed up by another large volume candle at 1050. Both of them going in opposite directions. So no true conviction as far as what the market wants to do. Outside of those two volume candles, large volume, we've had none but small bodies, a lot of small indecision dojis. So the market has not clearly decided what it wants to do yet. So I shall remain patient. I shall remain patient, showing you my trading view chart as well. Still looking for a call above 710. Still don't want to entertain a put until we break below that 705. You can see even here on this diagram, we came hit this area of support that I have identified here in blue and bounced right off of it, and that is the 706 area. So I do now have an alarm at 706, seeing if we can break that 706. And if we do break that 706, I will be looking to entertain a put. Right now, the market is doing what it does. We do want to keep up a little bit of pre-market. Let me see what it looks like when we take off pre-market, see if there's any visual effects. Okay. So I have removed pre-market, and now we just have Friday's and today's action here on the 5-minute chart. So we can clearly see why I want to get below that 706. That will be getting below Friday's low. Then that will also look good for some continuation towards the downside. See that?
Time for a news update. Let's get to Pippa Stevens. Morning, Pippa.
Good morning, Carl. FBI Director Kash Patel this morning filed a lawsuit against The Atlantic, seeking $250 million for what he claims is a defamatory article detailing his alleged abuse of alcohol. In response, The Atlantic said that it stands by its reporting and will vigorously defend against what it calls a meritless lawsuit. French prosecutors today summoned Elon Musk and former ex-CEO Linda Yaccarino to Paris for voluntary interviews as part of a probe into allegations of misconduct on the platform, including for deepfake content and the spread of child sex abuse material. Musk and Yaccarino have yet to say whether they will appear. Several other ex-employees are scheduled to testify this week. And President Trump over the weekend signed a new executive order to speed up access into medical research and treatment with psychedelic drugs. The order directs the FDA to expedite review of drugs such as Ibogaine, which veterans groups have said can help treat post-traumatic stress disorder and traumatic brain injuries. Sarah, back to you.
Okay, interesting. Thank you, Pippa. Up next, Chris Verone of Strategas, why he says the discretionary sector is flashing signs of life, plus 2 names in the travel sector that he's adding to his breakout list. That's when Money Movers returns. Welcome back. Major averages off the lows of the day. S&P 500 and NASDAQ pulling back from fresh record highs, though still on Friday. For more on the market, let's bring in Strategas chief market strategist Chris Ferrone. It does become harder to find more exciting opportunities in your world of charts, right? Yeah. When you have the market at a record high. But what stands out?
Listen, we'll take new highs all the time. Don't fight a new high. I think what's really most important is kind of how the week ended under the surface last week. Nearly 50% of the S&P made a one-month high on Friday. 60% of the Russell 2000 made a one-month high. And when you're looking for signs of how much staying power does a rally have, I think the internals provide some clarity. And that's the best reading that we've seen in basically a year, going back to the Liberation Day lows a year ago. So the expansion to new highs, while it can prove to be short-term overbought, is generally a pretty good duration signal when you're looking out 6 and 12 months in the future. And I think, Sarah, importantly, at the sector level, it's really discretionary that has awoken here from, frankly, a 12-month slumber. There's been no momentum under the surface in this sector for a year. Last week started to change that here.
Why? Is that tied to oil prices and gas prices, or what?
You know, I think when you look at the leadership fabric here, discretionary starting to make new highs again versus staples, cyclicals making new highs versus defensive. I think it's the market's way of communicating to us that, listen, the economy is still okay throughout all of this. You know, our whole approach this entire, 6-8 week conflict has been price action first, headline second. And if you think about the market from that perspective, you have to go back to, I think the high in oil was March 11th, yet the headlines kept getting worse and worse and worse and worse. So this is a market that I think has moved on from what's happening over there, and it's now focused back on earnings, which have been pretty decent. I think the tax refund season has been better than expected here, so the discretionary stocks seem to be reflecting
This is
that.
exactly what we were talking about at the top of the last hour, and all the commentary we've had from the regional banks, from the big banks, from some of the early consumer companies has been quite positive and suggests resilience from the consumer in light of these higher gas prices.
I think at the end of the day, when you look at a long-term chart of the S&P and you lay over every geopolitical event in history, they're blips. You can't notice them. But when you lay over financial crises, you can. So to us, the bigger question was always not when does the war end? It's, is there something more sinister among the financials actually brewing? And it's just hard to make that your base case when credit spreads have come all the way back to where they were pre-Iran. It's hard to make that the base case when Citigroup is making new price highs and Goldman and Morgan blew it out last week. So I think the financials and the credit conditions are frankly the more important backdrop here as opposed to what's happening in the Middle East.
Coming into the conflict, financials were the worst sector of the year.
I mean, listen, I think when you separate between banks and other parts of financials, the banks have held up remarkably well, not just in the U.S., in Europe, in Japan. And I think when you look at the kind of imperiled parts of the sector, the private capital stocks, I mean, Apollo hasn't made a new low since March 2nd. This entire event it's actually been an outperformer. I think there comes a point in that group of names where you just have to start wondering what could go right. I mean, the attitudes on private capital have gotten so pervasively bearish. There's still downtrends, I get it, but there's some momentum here. I think they want to rally.
Do you think IGV can build on last week? I mean, that was crazy.
Well, I think what we're learning, when you look software by software stock, is who's actually starting to exhibit some relative leadership here. I actually think Oracle is interesting. You go back to Oracle, it's bottoming at the 200-week moving average, which is where it bottomed last year. It's also where it bottomed in 2022 and 2020. I think the move in VeriSign last week was notable. Really good long-term chart. So we're looking for kind of on this software rally, what's not just bouncing, but what's bouncing with some relative strength behind it as well.
Do transport's all-time highs make sense given, I mean, there's a name that you would think maybe would start pricing in some geopolitics.
A couple of weeks ago, we wrote to clients, the less you know in this business. And I think transports, trucks, rails are exhibit A of, quote, the less you know. Who would have thought? And, on top of that, throw in Marriott and cruise lines and hotels that...
Viking, you have.
Yeah, Viking, Marriott, that it was this environment that actually pushes these stocks to new highs. Pretty remarkable resilience, especially on a relative basis. And I think it's a good reminder when you're in these corrective phases, pay very close attention to what's breaking out first and what's making new highs first. And the travel space has been fantastic. The transports, as you know, particularly trucks, I think ODFL breaking out today, JB Hunt
JB Hunt all-time high today.
Don't stand in front of that. I think at a minimum, Sarah, you can't make recession your base case when you have Citigroup at new highs and transports at new highs.
No, I mean, it's completely contrary to the narrative or the media,
great,
the negative headlines. Like, No, they're just buying Marriott shares. I mean, shares of transports, which you would think it would get hit so much harder, and the cruise lines on the result of higher oil prices.
You know, it's been such a good reminder, particularly the last 4 or 5 weeks, and it happens every couple of years, that narrative is so less important relative to what the market's actually communicating. We always say in our work, it's not my opinion you should care about, it's the market's opinion you should care about. And I think when you look at that very pro-cyclical message, again, new cycle high last week for equal weight cyclicals versus defensives, that does not seem to be an economy that's particularly
on the ropes.
uneasy.
But markets can be wrong and and overdo a certain move. And also, you know, you do have the speculative stuff, which Mike Santoli highlighted early, also outperforming and rallying. And I do wonder if there's any warning sign there.
Listen, I think when you look at the quantum stuff or the ARC stuff, which has kind of been the hood ornament of speculation over the last couple years, my sense is, or my suspicion is, they will not be the main event or the main story as we look through the remainder of the year. I still think 2026 is about real stuff, real stocks, old economy names. I think that's the transports. I think that's the discretionary names, the industrials, the power. And in a lot of respects, when you kind of juxtapose what was happening pre-Iran to where we are today, not a lot has changed. And I think often these events do more to reinforce or, you know, even reemphasize what were the existing leadership. That certainly seems to be the case coming out on the other side.
All right, Chris, thanks for joining us.
Great to be here.
Bullish Outlook, Chris Verone from Stratega.
When we come back, why shares of Cleveland Cliffs are down despite a smaller than expected loss, and reiterating for the full year, although off of the session low. Stay with us. Welcome back. Watching shares of Cleveland Cliffs today off the lows, but still down despite of reporting a smaller than expected loss. Revenue did top street estimates. The steelmaker saying Q1 results reflected the impact of short-term headwinds like energy prices and price realization lags, but they expect both to improve moving forward. They did attribute extreme cold to an $80 million one-time energy cost impact. In terms of the outlook, CLF leaving its full-year guidance unchanged. The company's CEO saying the ongoing disruption in the Middle East has made Cliffs' competitive position stronger and underscores why global steel producers want to partner with Cleveland Cliffs. Right now, as you can see, shares down a couple percent, stocks down about 30% for the year, still up more than 25% over the past 12 months.
This is why Dave Bird of U.S. Steel last week at our Invest in America conference was so happy that he was not a public company anymore. You know, doesn't have to talk about the short-term swings and the sort of cyclicality of the steel market now that Nippon is the owner. Now they talk about investment and opening new plants, creating jobs. So interesting tell there. Yes. When we come back, an early investor in Anthropic joins us to discuss the company's diplomacy push in Washington, as the NSA is reportedly using Anthropic's AI tools despite being blacklisted by the Department of Defense. Welcome back. A new report says the NSA is using Anthropic's Mythos preview model despite the company's blacklist by the Department of War. Kate Rooney looking into that for today's Tech Check, Kate. So how does that work?
Hey, Sarah. So we are seeing a lot more evidence that Anthropic's AI technology is actually critical to the U.S. government, despite the Pentagon saying that the company is also a major risk. Axios now reporting that the National Security Agency, NSA, is among those using Anthropic's newest model, Mythos, citing sources. The agency and the company did decline to comment on this one. It is Anthropic's newest model that's only being released to about 40 companies and then reportedly some government agencies just for cybersecurity. The company tells me it's not going to be releasing this to the broader public yet. That is still the plan, but NSA, notably part of the Department of Defense, and in March, the DoD did label Anthropic a supply chain risk. The president said they would, quote, not do business with the company again. It does come after CEO Dario Amodei met with Treasury Secretary Scott Bessent, Chief of Staff Susie Wiles on Friday, both sides calling that meeting productive. After that, the ongoing use of this technology in the face of this legal battle, guys, with the government is a big sigh of relief for investors that I'm talking to. Investors in Anthropic in particular, those I do speak to, had been really worried about the contagion risk, essentially, of any sort of prolonged fight, what it might mean for this really lucrative enterprise business. Company recently reported a $30 billion annual run rate in terms of revenue. The power of Anthropic's tech and the macro risk of cybersecurity out there does appear right now to be outweighing some of this political drama. Two sources also at the same time telling me Anthropic has fielded offers for equity investments that could, if they accepted those, would value the company closer to $800 billion. I am also told by sources Anthropic is not raising capital right now in private markets. This is one of the major tech companies, of course, slated to go public. Anthropic was last valued just under $400 billion after its recent fundraise. At the same time, market share overall is shifting a bit. According to new data from RIMP, Anthropic is getting an edge here. They are making progress. About 30% of all paid AI subscriptions, making a little bit of progress. OpenAI is still ahead. It's got about 35% of market share. You can see the chart there from RIMP, but definitely cutting into that and getting some more momentum, guys.
Wow, yeah, don't turn around, OpenAI. Someone may be gaining on you. Thanks, Kate Rooney. For more on Anthropic, let's bring in AMP founder Anjani Mitta, an early investor in Anthropic and former general partner at Andreessen Horowitz. Great to have you with us. Thanks for the time this morning.
Thanks for having me on, Carl.
What do you make of the use of Mythos? Are there cyber needs outweighing whatever feud the Pentagon may have with them?
Oh, absolutely. My view is it's about time. I think I started teaching this class at Stanford 4 years ago called Security at Scale. At the time, I was running the platform org at Discord, and we started to realize there are nation-state sponsored attacks against civilians that most people don't know about. And at the time, my co-instructor who was running infrastructure at Apple and I said, it might be time to start educating the next generation that cybersecurity is a mission-critical area that we need more education in, because the vulnerabilities, the speed, the scale of attacks, especially on the software supply chain, have just exploded over the last few years. And so I get very excited when I see the Anthropic guys actually prioritizing this area. It's been a busier area in the software community for a long time. For those of us who've been following what's going on, it's like when will something show up that actually allows us to make meaningful progress on this front? And I'm so excited to see finally more and more leaders start to adopt the capabilities that Anthropic's putting out in mission-critical contexts.
You applaud policymakers beginning to get it, it sounds like.
About time, yes. But, better late than never. But, yes, it's about time.
Although I'm sure you did not applaud when the Pentagon blacklisted Anthropic. Does that influence the investment case for this company?
I was definitely surprised, but on the other hand, I've stopped, very few things surprise me anymore. I've been in the frontier AI world now for, over a decade. And, what I've learned is that leaders just don't update their priors fast enough. And often when you actually come down to the substantive debate, it's not that, most people actually aligned. There's not that much difference between the two parties. And I think when you sort of boil down substantively, right, like what was the actual core issue, it's quite simple, right? Basically, I went to grad school for machine learning at Stanford, and what you learn in grad school 101 is that models are statistical in nature, right? And they have certain error bars because they're predictive models. And unlike a spreadsheet, right, which is somewhat more deterministic, where if you put in, some formula in a spreadsheet, what comes out is fairly predictable deterministically. A statistical model just always has certain error bars. And so if you're going to deploy that in use cases, margin of error is so low and the sort of risk of failure is so high, then we might need to actually update the way we procure certain kinds of software. Now, these are both ultimately still software, but when you have different categories of software being used in new ways at new speeds and scales, then I think it makes sense to sit down and have a conversation and say, hey, you know, this is how you deploy spreadsheets in a military context. This is how you deploy a statistical model in a military context. And maybe, just maybe they're the same thing, but just given their new capabilities we're observing in these models, hey, why don't we all just sit down, discuss what the capabilities are like, where the risks are, and we come up with a new procurement protocol or some new way to align on what the risk tolerance is, and then, you know, you're free to do whatever you want, but at least we had a discussion. You know, as I unpacked with both friends in government, leaders who called me up and said, Anj, you know, what's going on? Why can't we all just work together and get along? What I learned was it ended up being more and more of a cultural difference and more sort of a performative difference. So there was a moment in time, people are stressed out, the technology is kind of hard to grok. But at the end of the day, these are pretty simple issues, and I think these will get resolved. You know, I have faith that cooler heads will prevail, and that's why you're starting to see progress and so on.
Oh, that's interesting. There is an ongoing debate, though, about sort of the gloomy memos that are coming out of say, Dario or others about the negative externalities that may come to society once AI matures. Do you think those kinds of memos are constructive or not at this point?
Well, I think it depends on whether they're being read in context, right? I think remember, Dario's an empiricist. He's a physicist. What's so amazing about him and most of the co-founders of Anthropic, who I've had the chance to, many of them are personal friends. I've had the chance to know them over years. I was involved in the first, early days, as well as the most recent round. I've had the privilege to just invest, throughout the journey. And what you learn consistently is they see themselves really as educators, right? They do a lot of empirical experiments, and then they sort of try to publish a fairly reasoned and first principles approach to what will happen based on the diffusion of AI, because it's just such a powerful technology. The benefits are so vast that we're not going to stop the progress of this technology. I think we've all understood that. The world is starting to understand that. And so I think they try to do their best for the space by trying to explain, hey, here are multiple scenarios that could happen. The future is not sort of predetermined. You had a great piece called Machines of Loving Grace, which actually sort of presents a fairly optimistic view. But at the same time, generally I find the Anthropic culture is very much of, hey, we have a responsibility to explain how these things could go wrong in a fairly measured, reasoned way. But then, the various sort of, in America, we love taking things out of context, clipping them on Twitter, blowing them up. And the second and third order effects of taking those pieces out of context is definitely not helpful. And so that's one of the reasons I started teaching my class. It's called Stanford CS 153. I believe it's the largest computer science class on campus this quarter. But more importantly, we publish all the lectures online. And we've got leaders like some of the co-founders and leaders of OpenAI and NVIDIA. Sam from OpenAI, Satya from Microsoft, Jensen from NVIDIA. We had Amanda Askel from Anthropic on Friday. And we sort of try to do a first principles breakdown of what's going on in AI infrastructure so people can educate themselves and then reason about what they're hearing from Anthropic in context, what they're hearing from OpenAI in context. It's just a base level of literacy that I think is missing in the space, including from the capital markets, by the way. And so people need to stop freaking out, chill out a little bit, educate themselves, and then I think we'll all realize that there are risks, don't get me wrong. And the technology is so powerful at mission-critical contexts that we have to actually start educating ourselves about the risks. And many of us are now involved in purchasing decisions and deployment decisions at scale. But I think step one is we got to educate ourselves about what's different this time, because some things are meaningfully different and what's the same.
It sounds like we all need to take your class.
Or at least let us stick a TV camera in it.
cs153.stanford.edu. Also, the lectures up online on YouTube, so you can find them. We put them up every week. The kids like to call it AI Coachella.
Anjali, appreciate it very much.
Good branding.
Anjali Mehta with AMP. Great discussion as we come off these session lows here. A lot of all-time highs today. Ross Stores, FedEx, GE Vernova, JB Hunt, AMD, bunch of them.
So you've got a mix of the AI trade in there with some of the consumer discretionary trade in there as well. Look, we'll get retail sales for the month of March tomorrow. I think that'll be a good tell. The headline number is going to be high because it factors in the rise in gasoline prices and gas stations. But the key will be looking at, stripping that out, the control group, which goes into GDP, and the difference between that and the headline number, and that gives you a sense of how the consumer's been behaving in March. But so far, the commentary has told us so far so good.
Right. And then, of course, Fed confirmation hearings will be the other part.
Yeah, we'll take the Kevin Warsh hearings tomorrow. Yep. Obviously, key question of, is he still pushing for lower interest rates, right? And independence of the Fed. Yeah, after comments last week from Myron and Waller about how quickly some of these things are changing. Frank Collins in for the judge. Let's get to Post 9.
Thank you, Carl and Sarah. Welcome to the Halftime Report. I am Frank Collin in for the Judge Scott Wapner. Front and center at this hour, the pullback in stocks as more Iran uncertainty puts the market's recent win streaks in jeopardy. We'll debate the setup from here with the investment committee. Joining me for the hour, we have Joe Terranova, Steve Weiss, Rob Sechin, and Bryn Talkington. First, quick check on the markets. You can see a lot of red on this board. The Russell's the outlier, up about 0.5%. The Dow pulling back fractionally right now. The S&P down about 1/3 of 1%. The NASDAQ down more than 0.5%. And on jeopardy, breaking its 13-day win streak. That's one of the win streaks we were talking about, Joe. Obviously, a lot of this action follows the president saying that an extension to the ceasefire is unlikely, also making some other comments saying a lot of bombs would drop if the ceasefire isn't somehow resolved, And over the weekend, the U.S. taking an Iranian ship into custody. Are you surprised the markets aren't pulling back even more with that?
No, I don't think I'm surprised because the market has proved itself with a very strong degree of resiliency throughout 2026. So this is just playing to the script. The VIX is still below 20. The price of oil never got above where it was early Friday morning when we broke down at $92. To see today that technology, momentum, growth is taking a little bit of a pause after 13 consecutive up days, that's normal. That's exactly what you would want. Now it's time for the S&P equal weight to kind of join and participate, the Dow Industrials to join as well. You have 52-week highs today in stocks like FedEx and Target and State Street and eBay outside of the technology names. So not surprised by the resiliency at all. Very consistent with the script for 2026. And I'll say this, it's tough to be a bear.
It is very tough to be a bear right now. Brent, I want to come over to you. One of the things I was looking at, if you look at the VIX today, it's actually lower than it closed on the day before the Iran strikes. Is that complacency? Is that resilience? How would you categorize that when we're seeing a market that doesn't seem to be concerned, even as geopolitics and some of the tensions there, they just continue to ramp up?
Right. I mean, this goes back to what we've seen across most wars or whatever we're going to call this, invasions, et cetera, is that the market quickly digests the fog of war. And I think one of the reasons, outside of a huge amount of short covering last week, a ton of, we'll say, mechanical systematic buying, is the 10-year. I mean, the 10-year's at, what, 425, 426? And so I think that 10-year being so well anchored and actually falling about 10 basis points over the last week tells us that, to me, what the market thinks around inflation. And so to me, as long as that 10-year stays around these levels, that's very constructive for stocks. And I think also what's interesting is if you go back to 2023, we've had 5% drawdowns, and we get this whipsaw up every time where within a month, we're above that prior peak. We hit that again, and every time the market has gone meaningfully higher. And so I think to Joe's point, it doesn't get that much more complicated. This market is incredibly resilient because we have low yields and earnings to back that up.
All right, Steve Weiss, I want to come over to you. As I mentioned, some headlines that would make, I think, a normal market or a market any other time kind of waver a bit. Trump goes to Bloomberg, ceasefire, highly unlikely to be extended. I keep saying suspended, extended. The U.S. also struck and seized an Iranian-flagged cargo ship. I mean, certainly, if you were someone who said, oh, I think it's going to be resolved in a few weeks, it doesn't appear that way anymore. Are you surprised by the market action? Where would you go if you wanted to put money to work?
Well, first of all, I'm going to challenge your initial characterization of a pullback. This is nothing. I mean, we've had the quickest move from oversold to overbought in 40 years. And this is nothing. This is like a blemish. This is not a pullback. Look, I think that the market's appropriately ignoring what comes out of D.C. and what comes out of Iran. Number one, in terms of D.C., you just haven't been able to believe anything that's come out of there. It's all hyperbole, and a lot of it isn't moored in facts. So, and that's true of Iran, of course, as well. So what's the best thing to do? The best thing to do is look at history. History is, as Bryn pointed out, these geopolitical excursions, always end up better for the investor than if you reacted during them, right? So if you take the longer term view, even an intermediate term view, then I think you're going to be okay. I think at this point, Trump, has not reading his mind, difficult to do, has some regrets and does respond to market action. So I got to believe that somebody's telling him, if he doesn't realize it himself, what the market would do if we bombed the energy infrastructure in Iran. You'd see inflation really spike up and stay there for a long period of time. So the market, again, is appropriately ignoring that possibility and sticking with what they know. So when you see markets sell off like this, it's an opportunity to buy. I think at this point, better hold on to your capital. Everybody knows you're going to have a great quarter in terms of earnings, 12 to 15%, depending upon who you're listening to and what your own analysis is. And there's always an opportunity to buy. But given the move we've had, I wouldn't be surprised to see, as we talked about on Friday, Joe, I wouldn't be surprised to see a little more of a pullback.
You know, Weiss, I actually agree with you. I mean, today's nothing compared to the rally we've seen over the last 13, 12 days, however you want to categorize it. Rob Sechan, how do you view everything? How do you view the fact that the VIX is actually lower than it was before all this started? Oil seems to be under control, and we're hearing some very bullish calls on industrials, tech. I mean, how are you viewing this market?
So, two things. When we went into this crisis, we had seen many stories play out on don't fighting the White House. They always pivot. They end up coming back and listening to markets. The other thing that we know is don't fight what the market is telling us. And the market is telling us that you want to buy these bottoms. The Mag 7's up 20% since the lows. We've had a V off the lows that's been twice as fast as the drawdown. It almost looks like a check mark. Cyclicals are leading defensives. Transports are at new highs. Credit spreads are contained. And sentiment, absent today, is still generally bearish out there based on positioning. So I think the pain trade is still higher, frankly, even though we're extended no rebut, as Steve has pointed out. And yet this is in the face, so equities definitely want to go higher. In Atlanta Fed GDP now, which is 1.3%, has more than halved since the war started. The market does not care. Does not care.
But does Rob Sechan care?
Atlanta GDP is always exaggerated.
And so, okay, listen. The market does not care. I can tell you that. Many are still underway. You look at Deutsche Bank positioning, it's barely moved off the bottoms. And so you're having this institutional chase. And so there is so much here right now that is predicating on a positive outcome here. But it seems like the probabilities that if you're listening to the White House, which has been a bad bet to bet against, and if you're listening to the markets to bet against. And so here's what we're doing. Let me just talk about positioning. Buying durable growers that are the beneficiaries in all this, because earnings in the market are extremely narrow, but they're fundamentally well supported. So we are way overweight the semis, way overweight the durable growers, the hyperscalers.
Well, you're answering my question. Where are the durable growers? Is it just tech? I mean, according to Goldman right now, Q1 earnings are tracking to be 12% higher year over year, with tech contributing to about 85% of the growth.
So why wouldn't you lean into that? Because it looks like not only are they delivering, they're beating on those expectations. So, you know, we own 6 out of the 7 Mag 7, sans Tesla. Okay, we own 14 to 18%, I think 18% of our total portfolio in semis. We are bet there. We also have some cyclicals. We have some energy as kind of a hedge to that. But this is kind of how we're thinking about it. It's worked well.
All right, so Joe, you look like you're thinking. Brand, you're raising your hand. Sorry to cut you off, but go ahead.
Position and sentiment, to me, are always two very important, powerful forces. So you're identifying that technology is going to be the overall lion's share of the earnings growth in this 12% plus quarter. Think about positioning. Did anyone anticipate that in terms of the way they were positioned 6 weeks ago? Or were people actually stepping away? Were people saying, no, we don't want the Mag 7? Not you, Steve. I know you wanted the Mag 7. But then you've had this very rapid rebuild in position in exactly the right place. You wanted it to happen in the Mag 7, in growth and technology, to validate the possibility that you could extend and make new all-time highs, and that the market was going to continue to have this script of resiliency and look past the headlines that are coming from the Middle East. Why? Because the valuations got cheap enough in technology. The valuations got cheap enough in the semiconductor industry and for the Mag 7 itself. And it became so overwhelmingly appealing when you knew that what you were going to be greeted with during this earnings season is continued remarkable earnings growth.
In an odd way, that ratchets up the risk, because I'm not sure that given the move that they've had, particularly in Microsoft, or maybe in Meta, that they can tolerate a disappointment. So the expectations are now very high.
fair.
I was not concerned about the expectations, 10, 20% ago, 20% ago with those names, but now I am.
We talked about some reactions. Like I think it was you and I talking. Like, what was the whisper number? I think it was Taiwan Semi. Beat all expectations, and still it sold off. So what was the number that people had in
great
mind?
points because they killed it. And now you're looking at Microsoft. They've got to do it on cloud, right?
Has to be Azure. Has to beat the estimates and the growth. Brandon, we don't want to leave you out of this conversation.
Well, I think, listen, I get the numbers. I'm bullish on earnings. But to put a little pragmatism in here, 50% of the upward revision we've received on S&P earnings since the beginning of the year, 50% is from Micron, because Micron's going to grow earnings 658%. NVIDIA is another key component. So if you actually break down, tech is going to contribute 80+%. Almost all of that is two companies. And so we have an incredibly narrow earnings growth market, which is based on two companies. And so I will say we do not have strong earnings growth across all of tech. It's very narrow. And so we'll see how that plays out. Maybe it doesn't matter, but I don't know any other time in history where so much has been because of two companies, just like impressive earnings growth year over year.
And further to the point with Microsoft, just a quick one if I can drop. Further to that, on Microsoft, what happened to Micron after they reported what I thought was a great quarter and what I thought was good guidance? It sold off dramatically. So you just got to be careful.
Sometimes good's just not good enough.
So the move was so powerful, but I'm going to say this. In a slower growth, possibly high rate world, secular growers should lead. That's what should happen. And the narrowness, to me, reflects correct market behavior. Right? So no big deal from my lens, as long as you're willing to own those that are delivering and you have more confidence in the Mag 7's ability to deliver relative to the other 493.
Well, Rob, can I give you a counterpoint? Are they delivering or have they delivered? BTIG's Krinsky out with a note saying that a semi-rally signals a pause could actually be in order. He's looking at the SOX. Had their largest 13-day rally since 2002, the largest into a new high since March of 2000. It adds to their conviction that a pause is in order when the SOX has been 16% or more above its 50-day moving average. I'm just getting a little technical. Into a 52-week high like it is right now. It's been negative 85% of the time a week later.
So that is not necessarily when you want to undulate the accelerator. I think technicals are great, but fundamentals that are driving these businesses to growth rates we've never seen in a secular trend, I think you have to pay more attention to. And that's why these dips in these names keep getting bought. So maybe they're right. Technically, they're overbought. You're going to get a little pullback. But I would buy that all day long until we see in the order books of these semiconductor companies some signs of a slowdown.
So it goes back to positioning again. So if you tell me that we have very narrow, concentrated earnings growth in technology, I'd ask the question, okay, how is everyone positioned? Are they positioned the way they were 6 weeks ago, or are they positioned the way they were today? Steve's right. I don't think you could use the positioning argument today on April 20th as strong a catalyst as you were able to use it back on March 20th. You just can't, because we've seen the rebuilding of positions. So I think you always have to ask yourself that question first. And for certain, it gets much harder from here because people have gone back into the areas of the market where they perceive the earnings growth to ultimately be. That doesn't mean you sell it. It just means you set your expectation and maybe you look for some other areas of the market to try and generate alpha.
That's a great point. I think Ed Yardeni out with a call on industrials, saying that right now their valuation multiples are high, but so are their earnings growth rates. The sector's three major indexes all remain on solid uptrends that started in 2022. Joe, I know you own a lot of industrials. You have a lot of exposure there. What do you make of that call? If you go deeper into the note, he basically says you need industrials, energy, and materials to power the tech investments and everything else we're doing. So right now may be a good time to get into industrials.
Well, I think it was a good time to get into industrials 18 months ago because they participated in the AI Halo infrastructure build out. We have industrials up 11.9% so far year to date, but it's the name like Quanta Services, it's Steve's Caterpillar, it's other names that are enjoying the benefits of the data center build out. So the growth of AI is just not isolated to technology companies. It is touching other areas of the market like the utilities, like industrials, and to a certain extent materials. Is it getting late in that cycle? I would think it's probably later than it is earlier. 18 months ago, when valuations were much lower, positioning was much less, and very few people equated the potential growth opportunity in the future with the build out of AI infrastructure. That's just candidly a much better time to get in than where we are today. So I guess, Frank, it comes down to the degree of ownership more than anything else that you have in a particular sector or an equity name. And when you look at industrials today, would I be as overweight as I was 9 or 18 months ago? No, I wouldn't.
CJ, I want to come over to you. Speaking of what you own, that matters right now. You own Lockheed Martin, Union Pacific, and also Ryder. Union Pacific in the process of trying to build the first intercontinental railroad. We were mentioning transports just a bit ago with FedEx hitting a 52-week high as well. Your view on the industrials and where you want to position?
We've done well. We've increased base deck back in December based on reasonable valuations, deliveries accelerating. This is Lockheed, by the way, working through their supply chain technicals and with their F-35 fighter. But they have healthy demand from what's going on geopolitically around the world. They're the largest defense contractor in the world, only pure play in the space from my lens, and being able to tackle highly advanced projects. We own it. We think the order backlog continues to grow and like it.
Weiss, you have a little industrial exposure as well. Caterpillar, Leidos, and GE Vernova. Are you going to stay there? Are those the places that you want to be as we look at, obviously, tech leading when it comes to earnings, but it needs the support of, building, materials, energy, et cetera?
Well, Leidos is on the defense side. So, and not only defense, they've got a consumer health business, which is primarily actually veterans, and they've got, of course, the airports. When you go through the metal detectors, that's there, the conveyor belts, that's theirs. Yeah, I'm going to see their stock sold off quite a bit on defense news, and part of it's a software issue as well, that they're believing that AI can come in and replace them, but they can't for now. So this, to me, is on sale. It's been on sale for a while. This quarter, I think, will get them back to where the direction management was. He's done an excellent job in terms of great quarters. In terms of Caterpillar, look, it's no secret. I mentioned this last week. I think it's flirting with overvaluations, even though analysts keep raising their price target. And we're seeing that game here, right? We're seeing that game across stocks, across sectors, where stocks are getting close to a price target or hitting it, and then analysts, without any justification, are coming out and raising price targets so they don't have to take it off the recommend list. I think that's a dangerous game to play and gives you a false sense of comfort versus historical valuations. So the short answer is yes, I'm staying in those names where I am for now on Caterpillar.
I'm just looking at some of the valuations in the 24 industrial names that we own in ETF. Vertiv, 90.
Yeah.
Quanta, 88. Howmet, 68. And then for the negative performance in the holdings, we have Uber towards the bottom. Uber's got a valuation current mid-teens.
Really?
Mid-teens.
That shouldn't be surprising. They've got some issues. The robo-taxi model will not be as profitable for them as a driver model. Don't forget, robo-taxis, the company assumes the cost of insurance. They assume the cost of maintenance, including mechanical maintenance, cleaning it. They assume the energy cost, whether it's electric or gas, versus the driver assuming all those. So that's a major change for their model and the profitability. And it remains to be seen, for example, if Waymo can be profitable.
Well, while we're talking about autonomous drive, you know what's going to power that? That's going to be software. Let's take a look at the IGV. Right now, it's up just over 0.5%, up about 7% over the last, or over 8.5% over the last week or so. Obviously, software has been one of the most hotly debated areas of the market over recent days. Our John Fort, he spoke with the Adobe CEO, basically saying, everybody's got it all wrong. The bears have it all wrong when it comes to software. We got a lot of software ownership here. Rob, I want to start with you. Salesforce is one of your holdings. Mark Benioff also out with his own op-ed saying basically the same thing. People have it wrong when it comes to software, and then he says they have it wrong when it comes to Salesforce in particular.
I think that's right, although the position has not done that well over the last year and over a year to date for sure. But it did re-rate to a 14 times forward. forward PE. This is a company that has consistently posted double-digit top-line growth with high margins and free cash flow yields. There's a lot that fundamental investors can like in this business. And we agree that legacy software is not standing still. They are integrating AI across their platforms. They are so embedded into the fabric of corporate America, including my business, that it's tough to make a switch away. And I think what ends up happening is they find their cadence. Maybe it's through an acquisition. We think that the fact that they're embedded everywhere provides some insulation to disruption. So there will be haves and have-nots, though. There is incredible power in also new technology that we're using. We have Anthropic Enterprise right now. It is remarkable what the capabilities of this technology are. Remarkable.
One other hotly debated part of the software stack is cybersecurity. Brent, you have some cyber holdings. You have the BUG ETF. You also own Fortinet. By the way, Microsoft out with a note today saying that they believe that there's a $220 billion opportunity for cyber as a result of AI. So more pushback to this idea of AI disruption in cyber. Just your take on this thesis, and some of the top picks are Palo Alto, CrowdStrike, Okta. I know you own Fortinet, but you also own the ETF.
Yeah, I mean, I think both things can be true, that you are going to have disruption, but at the same time, we all know that if you read about, the mythos from Anthropic, these AI technologies are getting just wicked smart and able to find 27-year-old bugs that have been in the system. So right now, they're letting the CrowdStrikes, the Palo Altos use the mythos internally to look at their own software. I think this will be a very good, we'll say, joint venture where these companies are going to use the best AI technology to keep all of us and all of our enterprise models safe. I just don't think it's realistic that you're going to have two companies, OpenAI and Anthropic, just own the world, because they don't have a user interface, an enterprise model. They don't have a software. I really think the winners in cybersecurity are going to be these same companies that are in bug, that are adopting this technology. And I will say one thing about software. I do think the Adobes and Salesforce, they are going to have to get off a seat-based model to a work-based model. And once they do that, I think that the market will re-rate that. But the seat-based model doesn't make any sense because the cost of compute is going to be higher, and that's how they're going to be able to monetize, is going from a work-based and away from a seat-based technology of pricing.
All right, Weiss.
Yeah, just to expand on what Bryn's saying, one of the major reasons that Salesforce is down is not because of not alone because of AI disintermediating it. It's because it's a seat-based model, the seat licenses that Bryn's referring to. And when you talk about, for example, Meta cutting another 10% of their workforce, and what are estimates now, 20-30% of workforce reduction, those are 20 to 30% fewer licenses that Salesforce can put into their revenue. So that's one of the big threats. And I believe that we may not even know who the winner is in cyber at this point, because the weapon that there's two types of cyber. There's blue team, and blue team puts up the defenses. And that's really what CrowdStrike does. What Anthropic's Mythos is doing, they're red team. So they're constantly testing the system for flaws, for faults, and for all that. That's a unique capability. We're investing in a company, a private company, that does exactly that. I tell you, there are very few that do it. So the technologies that are coming out, you just don't know how far they're going. We're still in early days.
But you also don't know, just like the implications of the internet back in the late 90s, retail was getting blown to smithereens. It spared nobody. Look at what Walmart was able to do across that time frame. In the embracing and partnership, the linkages, the connective tissue that Bryn just talked about, for those that are able to innovate around a new technology, it doesn't necessarily mean the end in mass. That's all I'll say.
But Walmart's a great example, but they had the balance sheet. And so while they developed their own online, right, which really became great over the last few years, going back to the internet, they have the store base to do it. So the issue is not that you're going to use Anthropic software necessarily. There are these companies, we've looked at a lot of them, that come in and give you the platform to build your own software at a lot lower cost than a seat license. So that's really the competition for these companies. They'll be take your data and build it out.
We got to put the utilization and engagement for tools like Anthropic, for Claude Max, which I'm using, and I share your perspective. It's phenomenal. It's a game changer in elevating your productivity professionally. But I think utilization and engagement is still remarkably low. So not been embraced.
So we got to leave the conversation there, guys. Sorry to cut you off. IGB up 0.5% today, continuing its rally. All right, coming up, more of the day's biggest movers and the biggest deals of the day. Plus, we'll debate the opportunity in one stock that's actually been left out of the recent rally. Halftime back in just 2 minutes. And welcome back to Halftime. We are back with breaking news. Let's bring in our senior economics reporter, Steve Leisman. Steve.
Right, CNBC obtaining a copy of the testimony that Fed Chair nominee Kevin Warsh will give tomorrow to the Senate. He will say this is a time of great consequence for the nation's economy. He says the most significant hinge point in a couple of generations and that economic growth potential in the U.S. is rising. All three of those things, a reference to Warsh's optimism about technology and what it may mean for the U.S. economy. He goes on to criticize the Fed for playing a larger role in the economy and society after the great financial crisis. He says the Fed extended its reach and stretched its hard-earned credibility. Monetary policy independence, the Fed nominee will say, is essential, but that independence is not threatened when elected officials state their views on interest rates, an apparent reference to the many comments that the president makes about Fed policy. Central bankers, he says, must be strong enough to listen to a diversity of views from elected officials. On Fed independence, he says it's largely up to the Fed. Low inflation is the Fed's armor to that independence, and inflation is a choice, and the Fed must take responsibility for it. Fed independence, he says, does not extend to all congressionally mandated functions. Fed officials, he says, are not entitled to the same deference in their stewardship of public monies or in bank regulatory supervisor policy in areas affecting international finance, among other matters. That is a reference to the lawsuit that, to the efforts by the Fed to quash a subpoena. He seems to be saying that the Fed should not have done so. The Fed must stay in its lane, he says, should not act as a general purpose agency. He has been publicly critical in the past of the Fed's, for example, efforts when it came to climate change. Fed independence is at risk, he says, when it strays into fiscal and social policy. Monetary policy independence, he said, is earned by steering clear of distractions. And one more thing, he says, I'm committed to ensuring that the conduct of monetary policy remains strictly independent. I am equally committed to working with the administration and Congress on non-monetary matters that are part of the Fed's remit. Frank?
Well, Steve, we got to get going, but very quickly, I want to go back to that one part you didn't really give a lot of explanation to, the part where he says basically low inflation gives the Fed independence. How did you view that? Is that a sense that he believes that, or you believe that he's going to come in with a hawkish or a dovish stance?
I don't think it necessarily means either. I think what he's talking about in that regard is if the Fed wants to be independent and stay out of the crosshairs of the politicians, get inflation right. And I think he begins from that standpoint because we shouldn't be arguing over this or that with the Fed. If the Fed gets inflation right, nobody's going to have much of an argument. It's something he said in the past before. He said previously in a lot of the stuff he's written, speeches he's gave, is that the Fed needs to get its dual mandate right from Congress, and independence will flow from that.
All right, our Steve Leisman with the very latest on Fed Chair nominee Kevin Warsh. Steve, always good to see you. Thank you very much. See you over there. Was there something there you heard that kind of made you perk up?
I just think it's really important. The Fed's job right now simply is not to make it worse. Okay, and that means in a supply shock, cutting now does little for labor and it risks de-anchoring inflation. So you're to be balanced about this.
I mean, that's a perfect statement on Kevin's behalf. Kevin's basically saying get inflation right and all the pressure comes off. As simplistically as you could state it, that's eloquently and perfectly the mission of the Federal Reserve. He's right.
So it's a dual mandate, though.
Just to Rob's point, then,
it's a dual mandate, but get the inflation first and foremost correct.
But the tool that they have are cuts or no cuts. So you're saying no cuts, essentially.
Risk of de-anchoring inflation is going to force hikes later. You don't want that. That's the worst case scenario. So don't do no harm. Don't make it worse. And what that means right now is being balanced. You're not cutting. I can tell you that. Doesn't make sense.
I don't think his statement is speaking to the moment, whether today the next move should be a cut or heaven forbid, a hike. I just think overall he's reflecting back on the last 15 years and saying, okay, let's get the mandates specifically correct. And then the pressure comes off.
Well, in all fairness, though, he is speaking to the moment when he's talking about public officials basically pressuring the Fed to cut. What other moment is he talking about? I don't ever remember Biden or Obama or any other presidents.
They all stayed out. Traditionally, they don't comment on monetary policy. Fiscal is different, but that was a rosy picture of what's going on. They're not just commenting on interest rates, they're threatening. Trump is saying, and he's doing it with the lawsuit on the building, right? On the construction. So let's not be Pollyannish about this. Trump's going to be in his ear every single day unless rates come down.
They didn't comment on anything.
I am not suggesting that his remark is intended to be guidance for where he thinks the next cut or hike ultimately is going to be. I don't think that remark is about future policy from Kevin. I just think it's an overall reflection. Okay. And if you think it's politically motivated, that's fine, but I think it's accurate.
Well, I think this debate's just starting. So we'll have plenty of time to parse everything he says when he testifies and every other question he answers. So we'll get to that later on this week, I'm sure. All right, now we want to turn to our Angelica Peebles with a CNBC News update. Angelica, good afternoon. Good to see you.
Hey, Frank, nice to see you. The Justice Department's Antitrust Division is investigating whether meatpackers engaged in illegal anti-competitive conduct. That's according to the Wall Street Journal, which says it was launched after President Trump called for a probe into the companies last year, claiming beef companies manipulate prices for cattle and drive up prices for U.S. consumers. The DOJ is separately investigating the egg, fertilizer, and crop seed markets. A tornado hit a Rivian technology factory in Illinois over the weekend, damaging a building used for its R2 SUV, which is supposed to begin rolling out in the next few weeks. Rivian has not said if the temporary shutdown will affect the release. And Philadelphia will offer free transportation after World Cup games. A report from The Athletic says attendees will have to pay the $2.90 fare to get to the games at Lincoln Financial Field, but a partnership with Airbnb and the host committee will allow riders to leave for free. This follows headlines last week that round-trip New Jersey Transit tickets to MetLife Stadium from New York City will cost $150. So it'll be interesting to see how that all shakes out and if they back down. Frank, back over to you.
My hometown of Philadelphia, trying to keep things affordable.
I was going to say,
Angelica.
Frank, I know you have a special place for Philly in your heart.
Thank you very much, Angelica. Good to see you, Angelica Peoples. All right, straight ahead, finding opportunity in the energy trade amid the volatility. That's next in today's ETF Edge. Halftime, back right after this.
We're back on halftime. I'm Christina Partsinevelos with your ETF Edge. Crude oil caught in another push and pull of headlines. However, the price swings are comparatively muted and are on a side, if you can actually do that. There might be a bigger reason for that. Joining me now, Paul Baiocchi, head of fund sales and strategy, SS&C Alps advisor. Paul, thank you so much for joining us today.
Thanks for having me.
Yeah, so energy has been negatively correlated to the S&P through this conflict, which you're saying is classic diversification. But is that an actual structural change or just what always happens when oil is the shock? And what convinces you that this sticks?
Well, even prior to the conflict in Iran, we felt strongly that the outlook for commodities and real assets was extremely strong in the coming years and decades. And it's largely due to the fact that those ingredients to the global race to invest in AI data centers, infrastructure investment, as well as the insatiable appetite to what goes into that investment, a lot of those commodities were on a knife's edge. In fact, coming into the year, oil was expected to be in a 2 million or so barrel a day surplus. And yet this conflict in Iran has flipped it on its head. So the takeaway should not be if there is a clean resolution here, to take a breath and move back to things like large cap growth and the Mag 7 and AI centric
Yeah,
stocks.
Jesse,
How
this
do I
is a
position my
nothing burger right now. Still holding on to my original plans from this morning. Let me go ahead and put those back on the screen right now. Still looking for a call above the 709 areas where my alarm was. Looking at 710, 710.5 for an entry for a call. Taking that to 712 and then possibly 715. For put, not interested until we get below 706. I moved it up to 706, 706 strike. Entry 705. Who knows? Might take a little nibble in that, but it's really not looking like anything. What's my biggest problem, my biggest concern with it, teammate, is the volume. The volume is looking horrendous. The volume is like people are waiting. People are anticipating. They're in an anticipatory stage. They don't really know what to think, so they just, really, like you said, yawn. It's really nothing going on. You know what I'm saying right now. You know what I'm saying? It is what it is. There's just nothing going on right now. But we know where to look. So as long as we still have that. We still know where to look. And so where to look, let me put it over here on the trading view chart. Where to look is for a call above that 710 area. And where to look is continuation if we're going to come down below that 705 area, start to look at 706. Okay, but what we've been putting in is very small, indecisive candles. The candle bodies have been very, very small, showing that no one is really committed right now. So the market is kind of lingering in between last Friday's lows and last Friday's highs. We're right here in the middle. Last Friday's lows was at that 705.8 area, and the high was at the 712, and right now we're at 707. So that's where we at right now, buddy. Glad to see you still hanging out with me, doing the best we can with what we are being given, and we aren't being given much. So there we have it. Again, the thing that's concerning me is the volume. The volume is just really, really nothing. We had nice volume spike, at the open, and then we had another one at 1050 when they put in this big red candle, but then the bulls came right back and started eating the tail up and got us right in the same area that we're in right now. But since then, the volume has done nothing. So with that being the case, I probably will not take a trade today. I probably will not take a trade today because we're at a complete nothing burger. And even this morning, we did nothing. We had a nice move, but nothing solid, nothing concrete. Yeah, just a nothing burger right now. It's a nice big nothing burger.
And welcome back to Halftime. Let's get to some committee stocks that are on the move. QXO to buy commercial roofing firm Top Build for $17 billion, making this an M&A Monday. Weiss, you own QXO.
Look, this is a phenomenal acquisition. Right now, what you're seeing is the ARBs come and play, where they sell, obviously, the acquirer and buy the target. But, when Brad took over, he said, look, this is going to be a $50 billion revenue company. And here we are just a couple of years into his playbook, which he's run at United Rental, he's run at XPO, he's run at GXO, and we're at 18 billion in revenue. So he's a value buyer. He's getting into this for the right price. And I just think that you want to go along with a proven moneymaker.
All right, Brad Jacobs right here at Post 9 early. You can see the whole thing on CNBC.com. I'm going to go to our next one. Eli Lilly to buy cancer drug maker Colonia in a deal up to $7 billion. Rob, you own Lilly.
Yeah, this is a great business. We trimmed it quite a bit when it got up to 54 PE. It's now back down quite a bit. I think it's 27. And so they're clearly the front runner in the GLP-1s. It's the dominant growth driver. We also see great expansion into oncology. While it's not the cheapest, I still think there's opportunity in this name at these levels.
All right, want to move on. Robinhood's price target raised to 115 from 105 at Mizuho. Bryn, you own this one. Looking at the chart, it's been under quite a bit of pressure this year.
It's been a bit under pressure this year, but it was up 30% last week. Huge short covering, and then risk appetite back on. And it's still up 114% over the last 12 months. I wouldn't add new positions here. I'd actually sell calls here. It's got a lot of resistance at $100. Their earnings come out on the 26th. They're going to be fine. But I would have bought it last week, not once it's had a 30% move after massive short covering.
All right, want to go on to Berkshire Hathaway, really left behind this month as the S&P has rallied to new highs. Shares actually down 1% in April. Joe, you own this one.
52-week high was May 2nd of 2025. So that really speaks to the lack of participation. The fact that the stock is 12% off of that 52-week high and has underperformed the S&P 500 from 9%. Greg Abel coming in certainly is going to change up the portfolio. One of the deficiencies over the last year has been the absence of technology itself in the portfolio, selling out of Apple a little bit too soon. But also, let's remember, $380 billion in cash. That's a problem. If you were to put that in the S&P 500, you would have gotten a better return than it just sitting there in treasuries, which is where that capital ultimately has been.
All right, we got one more call. Wolf out with a note on the home builders, saying they're ripe for short-term trade higher. Joe, you own Pulte.
You have to see rates lower. I think a lot of people have called for a bounce in the home builders. There's been the appearance and price that there was a potential recovery rally underway, but until you see precipitous fall in residential private sector borrowing costs, that's the recipe, that's the elixir for a better home builder environment. And we're not there.
Looking at Pulte right now, though, shares up about 1/3 of 1%. Coming up next, Mike Santoli joining us with his midday word. Halftime back right after this. And we're back on halftime. Senior markets commentator and overtime co-anchor Mike Santoli joining us with his midday word. Mike, always good to see you. We talked a bit earlier about the VIX. VIX actually below the level it was before the Iran conflict started. Looking at oil, it's under $90 a barrel. Sure. Despite what we've seen, even looking at bonds, which you often kind of educate me on. They're not necessarily a headwind for the market, but right now the 10-year at 4.25. Does this all mean the market's over all this? It's just decided we're moving past it?
I think it's comfortable with where we are right now. I don't know that it's like assertively saying that we have an all clear. It's not really an all clear. It's much more about we think we can kind of roughly quantify and set aside the things that are directly at risk. Now, you mentioned the VIX. Yeah, it's below 20, but guess what? It's up a point and a half today. And I think that is the one part of the market where you're accounting for one, you're in a new week. That always happens on a Monday. You kind of rebuild a little bit of the implied volatility. But also, there is an inherent, we don't know exactly how this is going to go. However, if you're looking at the S&P 500, it's almost like a textbook benign digestion day after an amazing run. Half the stock's up, half the stocks are down. A lot of the big growth names that did have this huge momentum surge are calming down today. So I think this is really the preferable way you'd see a market cool off when it got a little bit overheated in the short term. And I keep saying it, when markets make new highs, it's more positive than negative, even though you can go back to one instance where we had a 13-day win streak like this to a new high. It was March of 2000. The rest of those times are not as scary as that instance was.
All right, we'll just have to wait and see. Mike Santoli with his midday word. We'll see you coming up later today on OT. All right, final trades there coming up on halftime. Stay with us.
Are you following the Halftime Report podcast? What are you waiting for? Look for us in your favorite podcasting app. Follow the Halftime Podcast now.
And we are back with final trades. Bryn, you were up first.
Yeah, Capital One, earnings come out tomorrow, so be mindful. Stock is out of its downtrend. I like the stock technically, and I think earnings will confirm that tomorrow.
Rob.
Breaking my own rule, buying a down stock today, but I think Broadcom continues to be one of the biggest beneficiaries of AI capital spend.
Weiss.
Alibaba, I mean, the stock's had a nice bounce from the lows like so much of tech, but I think keep going.
Joe,
Maybe I'll get even, actually.
Joe, you got the last word.
March 30th, Valero found its peak. It's pulled back into the critical and supportive moving averages. This is a classic moving average fake out. You want to buy it into these moving averages here, 225 to 230 area.
All right, one more quick look at the major averages right now. In the red across the board, with the exception of the Russell, up about 0.25%. Looking at the Dow, it's pulled back right now, just fractionally. The S&P down about 1/3%. The Nasdaq on pace to break its 13-day win streak. That does it for halftime. The exchange starts right now.
Thank you very much, Frank. Oil prices are higher today, but stocks are barely down from Friday's record highs. Welcome to the exchange. I'm Kelly Evans. Iran has vowed to retaliate after the U.S. seized one of its cargo ships in the Strait of Hormuz. The current ceasefire is set to end on Wednesday. A source familiar tells CNBC the U.S. delegation plans to travel to Pakistan soon to continue talks. But whether the Iranians show up to negotiate is still unclear. Let's bring in Jonathan Panikoff. He's director of the Scowcroft Middle East Security Initiative at the Atlantic Council. Jonathan, great to see you again. Just pointing out the disconnect here. The rhetoric sounds one way. The market is basically at all-time highs. It's clearly looking in another direction entirely, and maybe seeing the pressure it can put on the president to some extent to kind of have him come to what's left of a happy resolution here.
Yeah, I think that's right. Look, I think the president actually is looking for the off-ramp that he's been looking for a little while. But of course, the Iranians get a vote here, frankly. And I think for the Iranians, look, they've always been playing on a longer timeline than the president is. I think they thought that they could outlast him. The reality is we're at a point now where for the president, it's going to be challenging to keep going, especially there's going to be a squeeze, I think, even more on the energy sector and what that's going to mean globally. But also for the Iranians, look, the blockade now puts them on a different timeline as well. It shortens everyone's timeline, so maybe it actually will help prompt real negotiations here in the coming days.
A couple of things. So you said, the Iranians get a say. In what sense are they going to get a say? Is that say being expressed through pressure on the Strait? And then, as you mentioned with the blockade, how much more activity do you think the U.S. might have to get involved with?
Look, on the Strait, I think, yes, that's where the pressure is going, and it's going to continue. I think the Iranians view it fundamentally as a permanent deterrent now and a point of leverage that they're not going to give up. Look, you might be able to get rid of the toll booth. I think that would obviously be a huge factor and a positive thing. But there's going to be a question of, okay, where does Iran demand that you offset it in terms of sanctions relief so that they are not completely losing money that they desperately want and need to rebuild their own economy at least as much as they can, with some sanctions staying on. I think on the blockade, look, the problem is the U.S. really is going to be hard to do this long term. You're already at a point where you're seeing the longest deployment that we've ever seen from the post-Vietnam War era of an aircraft carrier strike group. It's very, very difficult, and there are significant trade-offs. By being so heavily invested in the Middle East, what are we giving up in the Indo-Pacific in terms of threats and challenges that we're not dealing with there? And I think both of those things are going to make it tough to continue just as we are into the future permanently.
You said you wouldn't be surprised if Pakistan, sort of the officials involved here, turned to China to help cajole the Iranians. And a lot of people have talked about this angle. But how exactly might they use leverage or influence to bring Iran more to the bargaining table?
Yeah, look, China's in a better position than a number of its East Asian brethren, frankly, right now in terms of the energy reserves that it still has, even in terms of what it's drawn down so far during this conflict. But long term, China doesn't want to see this. And China is obviously the biggest consumer of Iranian oil by a wide margin. The Iranians know that. There's a reason that the Pakistanis went to Beijing before negotiations started to ensure that they'd have the Chinese on board and supporting some sort of diplomatic pathway forward. And so I think it wouldn't be a surprise to actually seek Chinese help to once again pressure the Iranians, say you've got to come back to the table in a very serious way. My guess is some of that's already happening behind the scenes. If Vance is going out already, you probably don't send the vice president unless negotiations quietly have been advancing. And the fact they haven't leaked probably reflects that there are some serious movements. But obviously, there's still ways to go. China can help with that.
And so your expectation of further talks at this point, based on the reporting that we've seen so far, is that they happen?
Yeah, look, I think it's a little bit of a toss-up. Whether it happens immediately in the next couple of days, whether it gets pushed a little bit, I think it will happen. I don't know that we know the exact timeline of whether it's in 48 hours or say, over the weekend or into next week. I think all of that's possible. But the reality is I think the U.S. still does want an off-ramp here. I think Iran is going to be willing. Again, they're on a shorter timeline than they used to be. I think it's longer than the U.S. one, but they need to get to a resolution at some point as well. And I think pressure, you're going to start to see, look, you've already seen on East Asian countries, Vietnam, the Philippines have already prioritized, frankly, international flights. There's almost no domestic flights in those countries. We've seen the Italians in Europe now saying there's going to be 4 major airports. You're going to have to prioritize jet fuel. All of that pressure globally is going to start to have an impact as well. The U.S. and Iran both come to the table.
You mentioned, though, this idea that Iran now sees the Strait as an area where they can have permanent deterrence. It's part of their leverage. I mean, do you really think that's going to be the case?
I do, unfortunately. Look, Iran doesn't have to permanently be there in terms of having it mined or having its drones cascading over the strait indefinitely. But the reality is you can't change geography. The Iranians are there, they're there on the strait. And so I think it's going to be a deterrent factor. It's going to make it harder, for instance, for perhaps the Israelis to say they're going to take a mow the grass strategy and just keep bombing Iran anytime there's a problem, because then the Iranians are going to say, fine, then once again, we'll close the strait. And if you can't keep U.S. assets there, and you especially if you don't actually have an international mission from Europe, from East Asian countries, from others to help protect and keep it open indefinitely, then you're always going to be at the risk of the Iranians on a whim deciding they don't like some action and deciding that they're going to close it or at least threaten to close it. And that's going to become part of the permanent fixture here. I think the spread right now between the spot and the futures markets on Brent is telling, and I think it's going to be important, but I expect it's not going to recede nearly as drastically as many will think, say, months from now. I think it's going to be higher than it was certainly before the war started for quite a long time to come.
And it's just a final comment. I can't quite tell whether the stock market is voting to say we think it's unlikely that Iran maintains that position, or it's unlikely that the U.S. has to maintain this blockade much longer, or that maybe both of those things will be the case, but that it just doesn't really matter.
Yeah, I think that's right, and I'll be honest, I can't tell either. I think that the reality, though, is, look, maybe at some point you get to some alternative routes and alternative corridors. I think that's going to be one of the long-term lessons learned. But in the next 2, 3, 4 years, there are going to be a challenge here. And so I think there's going to be this question, not just obviously in the energy sector, but in the ag sector and petrochemicals, in any of the commodities, frankly, that have to deal with energy imports. This is going to be an issue for everybody. And so I think the market reaction right now is a little bit confusing. I think perhaps that's because the messages coming out of both Iran and the U.S. are also confusing. When there's clarity there, hopefully the markets will respond more clearly as well.
Maybe we'd prefer if there isn't, if they're going to look the way that they are. No, Jonathan, thanks very much. We'll leave it there for now. We appreciate it.
Thanks so much.
Jonathan Panikoff with the Atlantic Council. As we mentioned, this rebound off of the lows has been one of the sharpest we've ever seen. And while tech stocks are under some pressure today, they've also powered us to those new record highs on Friday. The Mag 7 driving the gains up 6% over the past week. And the group has added $4 trillion in market value just since stocks bottomed last month. Our next guest expects more near-term gains for one area in particular. Let's bring in Gene Munster, the managing partner at Deepwater Asset Management. Welcome, Gene. Hi. Before we get into the tease there and your big reveal, it is amazing to hear this discussion with Jonathan and the uncertainty that might remain over this, and it really, the stock market is really shrugging it off. And it's unbelievable that we're back at all-time highs. And the oil price, none of it seems to be, it's not skipping a beat.
It's not. I'm focused more on the tech side, and of course, the tech piece, it is all about the A topic and the progression of AI. And I think about the dynamics, whether it's geopolitical over the past, more recently, but the past couple of years, also inflation over the past 3 years. That used to be a big topic when it came to tech investing, trying to figure out what the Fed is going to say on their next update. And in fact, what's going on is that this is such a big move, hard to put adjectives around the type of transformation that we're having across the board with AI, that is in fact much bigger than what is going on geopolitically. And so that's kind of the dynamic that is playing out here more recently. And I think that investors can sleep well at night knowing that we still are early in what I think will be a transformation in AI. And when I talk about early, I mean that the hype is high, that the hype over the next 5 years, or the substance over the next 5 years, will exceed that hype. That's the key. Not whether AI is going to be impactful. I think everyone is in agreement that's going to have a big impact. It's the highest of that high bar. Can it exceed that? I think it will. If in fact it does that, we're going to continue to see these tech stocks do well despite what is a complicated geopolitical and Fed environment.
Sure, and you say there are two dynamics that have really been impactful here in the last little while in particular. Software is looking up, and the AI silicon trade, and explain what you mean by the AI silicon trade and how that's running ahead of expectations.
Well, that's, if we just look last week at what ASML said and TSM, they basically gave guidance for revenue growth this year to be higher than where it was last year. And specifically to TSM, they grew at 35% that just reported March quarter. They gave guidance for 34% for the back half of the year. And so that's a sign. They beat numbers by 2%. ASML is a little bit lumpier. These systems average about $150 million each. And so you have to kind of look at it on a yearly basis, but in general, they're basically saying the takeaway from those two important companies are saying that we still are early in this AI build out. So that's had an impact on it. And then of course, there's this other sector in terms of software and what's going on there.
Yeah, and why? So no one thinks, maybe I'm wrong, that software is going to be the leadership or anything like that. I think we all see the challenges here in the next few years, but the trade, how much better has it been doing lately?
Well, I appreciate that distinction between leadership and the trade, and I think that the trade is on. And I want to kind of zero in. Last week we had comments from Goldman CEO talking about that these AI headaches, that really sparked the software index to be up 11% last week. You mentioned earlier that the NASDAQ Mag was up 6%. The Mag 7 was up 8% last week. And so this huge outperformance from software from just that one comment. But then I would point to a Wall Street Journal article that came out at 10 o'clock Eastern last night that was highlighting some comments that Mark Benioff from Salesforce had to the Journal. And he basically said that many believe that our back is against the wall, but in fact, we have a huge opportunity in front of us. And Kelly, the reason why that's so important, the timing of that is so important, is Salesforce is on an April quarter. We're just standing about a week before their quarter ends. When large companies say things like that, when effectively they're ready to report their quarter and guide, that is a tell. And I go back to what we saw in mid-October. Liz Reed, who is the head of Google Search, went to the Journal and had some comments about how great Google's search business is. It was uncharacteristic for Google, again, a week before they were reporting their quarter, to have those kind of comments on the record. I think we're seeing a similar dynamic. And so I just want to point to, I'm negative on software long term. I think that we're going to see high unemployment. I think it's going to impact seat growth. But the near term, especially for Salesforce, Benioff is making a comment. If you're curious what happened, when Liz Reed back in October had her comments, what Google stock did, it had run significantly from April into mid-October. It went up another 33% versus the NASDAQ up 5% in the following 6 weeks. And so I think you're probably going to see a positive software trade. It doesn't change my skepticism about how this ultimately ends, but probably makes sense to be long software, at least in the near term.
What else? We have to go, but I'm just going to sneak in one more, Gene, which is where else do you feel high conviction? Where would you want people to be long, especially as you mentioned earnings season? You know, there's been some caution about the Mag 7 there in particular, but do you think they're all, you know, safe or attractive here? I don't know if they're as stupid cheap, quote unquote, as they were a week or two ago, but we haven't moved that much. If people still think that, you know, what you're saying has some merit and can benefit all of those major players.
The key is to focus on which companies have the potential to have narrative change. Salesforce is a company that can have a narrative change. Google had one last year. If you look at the Mag 7, the company that has a potential for a narrative change, the biggest potential is Apple. The narrative is they can't figure out AI. If they do show something that shows some substance around personalized AI, the numbers are going to be fine, by the way. They're going to beat their numbers. All the indications out of China are positive related to the iPhone. It's really about how investors think about their competency in AI in the weeks and years to come. And I suspect that we're going to feel better about that. So I feel really good about Apple here.
All right, Gene, thanks. Really appreciate it.
Thank you.
Gene Munster. Coming up, American Airlines having its worst day in over a month after rejecting talk of a potential takeover by United. Could a deal ever potentially get cleared if it's back on? We'll ask former Assistant AG Jonathan Cantor his thoughts on that next. Plus, Fundstrat's Tom Lee sees the S&P hitting 7,700 by year end, or 600 points higher now that we're over 7,100. He'll tell us what will help us climb those 600 points right after this.
This is The Exchange on CNBC.
Welcome back. Shares of American and United Airlines are falling after American said it is not interested in any discussions about a potential merger. My next guest says the deal would not have cleared antitrust review anyway, and he was at the DOJ when they struck down JetBlue's bid for Spirit. Joining me now, is Jonathan Cantor, Assistant Attorney General for the Antitrust Division under President Biden and a CNBC contributor. Jonathan, it's great to have you. Let's start with why you think this administration and the Transportation Secretary, Sean Duffy, indicated an openness to this merger happening. So it sounds like it could.
It won't. So this deal is a complete non-starter. The idea of American and United merging is like Coke and Pepsi merging. It's up there as one of those deals that's just patently undoable. And even if the current administration decided they would wave it through, the likelihood is so high that a state attorney general or a private plaintiff would sue to block the deal and succeed that I just don't see it as a realistic opportunity for the market.
Why?
So these are the two of the largest, most significant competitors in the industry. Here, you have to think about the backdrop. We've been dealing with consolidation now in the airline industry for 25 years. Interestingly, United, when it merged with Continental, was about the same size that JetBlue is today. And what we kept hearing merger after merger was that consolidation was necessary to fix the industry. But during that same period, the industry has deteriorated. The customer experience of flying is terrible. We have most, if you're lucky, if you have two options from any airport, most airports really have one option for most places you want to go direct. And so the experience has gotten worse, and the companies are more vulnerable to including to spikes in jet fuel. So the idea that consolidation has helped the industry, I think, is really belied by the facts when you ask consumers.
Is the government getting in the way here of, it's a highly regulated in some ways industry, right? There's regulation over the number of gates that you can have in these places. Describe the regulations that are currently in place, and are those all necessary? And is that partly what's at fault here? Because it's not as if, investors are frustrated in airline investing and have been for years. It's the butt of many jokes. It's not as if they're sitting pretty going, oh yeah, it's great that we're able to be so profitable. It's a terrible industry to invest in, generally speaking.
It's actually not nearly as regulated as people think. It used to be very highly regulated in terms of restrictions on where you can fly and what you can charge. And then around the 70s and 80s, it became deregulated. And the fact of the matter is only a handful of airports in the country, you can count them on one hand, where you have slot restrictions or gate restrictions. For the most part, it's completely unregulated. And that unregulated structure has resulted in actually less competition. But the benefit of the bargain, when the government deregulated the airline industry, they said, okay, we're going to rely on competition instead of regulation to help place the market. But during that period, what happened was the market reconsolidated. And now we have a situation where there's actually very little regulation relative to its role as critical infrastructure. And we have a situation where the large players are the only ones who themselves can succeed. But don't forget, 3 of the 4 large players, United, Delta, and American, have all declared Chapter 11 in the last 25 years.
Right, which sounds like an industry that struggles to maintain long-term profitability vis-a-vis Spirit. That deal, which I know you strongly felt was not the right one, was blocked. The judge said, I'm doing this for the consumer. Now it might be liquidated. If this industry has a problem maintaining long-term profitability such that the airlines are either going to go bankrupt or struggle to maintain, the kind of competition it sounds like the government would actually want them to have, do they have a point that they might need to combine in order to be stronger?
Kelly, I think you're making the point for more regulation, not less. When you have an industry that's critical infrastructure and it's failing, that's exactly when you probably would want more regulation rather than a free-for-all. In terms of Spirit, I think some context there is very important. At the time, Spirit had a deal on the table from Frontier. That deal was far cleaner from a regulatory perspective. The management of Spirit actually went out publicly, including on this network, and said a deal with JetBlue was undoable. It was undoable from a competition and an antitrust perspective. Notwithstanding that warning from Spirit's own management, the shareholders pressed it to take a few points additional on the deal and do a deal with JetBlue. JetBlue said it needed to merge with Spirit. Why? Because it needed to compete against the big guys. At the same time, JetBlue was proposing and about to defend in court effectively a merger of the Northeast with American. So the context, and it had documents saying that was going to raise prices after a merger. So that was a situation where Spirit management could have selected Frontier, had a much easier path from a regulatory perspective. Also, Spirit had the opportunity to go in court and tell the judge, if we don't do this deal, we're going to fail. They didn't do that. Instead, they went in, and the evidence that they showed to the court said, even if we don't do this deal, will be okay, which was true. Their stock price actually spiked after the merger was blocked. Distress and stress recently has come largely on top of higher jet fuel prices and then among other failures. Finally, I think there's another point here, which is imagine if JetBlue had purchased Spirit. Now JetBlue would be carrying the debt load of Spirit, which would probably have imperiled both airlines instead of just one.
It's imperiled anyway. It's a $5 stock. It's down 70% in the past 5 years. Spirit, Frontier, we show these stocks, they're all down 60, 70. These are you would think if these were monopolistic behaving companies that needed to be prevented from combining, that they would be making a lot of profits. These stock charts are terrible. These companies are imploding.
That's a function of the industry not being workable. This is what happened after deregulation. What we need in the industry, frankly, is we need a better path for these smaller airlines to compete. Companies like JetBlue, Spirit, and others need access to more airports. They need more subsidies on jet fuel. They need the ability to compete against the big guys, allowing them to merge with the larger players. And keep in mind, when JetBlue and Spirit proposed to merge, it would have been effectively a three-way merger between JetBlue, Spirit, and American. Letting the big guys get stronger is not going to help the smaller guys get more competitive. If to the extent that we want national policy on airlines, we need to do a better job making sure that the pathway for these smaller independent airlines is much more conducive to having consumer-driven airlines. Other problem is these larger airlines are now reducing their capacity for leisure travelers for cheaper seats and increasing their cabin size for business travelers and premium. And so we are in a situation that's the worst of all worlds and the exact opposite of what we were promised when the government deregulated airlines in the 70s and 80s.
The worst of all worlds certainly is the way it feels. I know and I think we all want to get to a highly competitive market where there's a great flight experience and an inexpensive ones and lots of options, and it just always feels like we're drifting away from that. And Jonathan,
Kelly, last word on this is what we've been told for the last 25 years is just one more merger will fix it. And what has happened is one more merger over and over and over again hasn't fixed it. I think it's time to go back to the drawing board and try to come up with a better solution.
I don't think, but who's going to the drawing board? The government saying, okay, here's Sue. All I'm saying is not allowing it to go through didn't work that well either. I don't know. I think that I'm not sure who it is out there that's going to decide how to fix the problem, but no one's happy. The investors are, other than United and Delta. They're the happy ones, I think. They're the only happy ones right now. So
right.
Maybe
and
United.
letting them buy up American's not going to solve the problem.
All right. Jonathan, thanks very much. Appreciate it today. Jonathan Cantor. Coming up, we'll look ahead to tomorrow's high-stakes hearing on Capitol Hill. The Senate Banking Committee expected to scrutinize Kevin Warsh's ties to Wall Street. A look at what exactly he's planning to tell lawmakers next. Stocks are pulling back slightly from Friday's all-time highs, and the Nasdaq is on track to snap its 13-day win streak. That's the longest since 1992. Dom Chu, we have just lived through history.
It's crazy because you'd think the market might be lower given those record highs that we saw on Friday. But let's start with a check on those oil prices right now, which are spiking again today to the tune of 6.5% after the ceasefire no more in the Middle East. U.S. benchmark prices just shy of $89 a barrel, up around 6% or so on the day so far. If you take a look at now the international benchmark, that's moving up as well. The energy ETF and some of the energy stocks are just now higher because of that. ExxonMobil and, by the way, Norwegian Cruise Line and Royal Caribbean are two of the names that are actually lower because of those higher fuel prices as well. So that's one of the things to keep an eye on. Then check out what's happening with some of the building supply companies in terms of the deal that we've seen so far. We have at least some of those things coming up right now where, at least in that way, let's pull it up here. Top build up about 18.25%. QXO is going to buy them in a big deal. It's going to make the second biggest building supplier out there in North America right now. So keep an eye on those particular names. They're going to soar about 19% after they agreed to this particular deal. $17 billion again in this one. The agreement does value each top belt share at $505. It's a 23% premium to its closing price on Friday. QXO says the deal is going to create, again, the second biggest publicly traded building products distributor in North America. And let's cap things off with another deal that's in the works right now. This time in pharma and biotech. Eli Lilly shares right now just about flat on the session, but you can see a little bit of volatility intraday. It agreed to purchase privately held Colonia Therapeutics in a deal that could be worth up to $7 billion. $3.25 billion is going to be paid up front. The deal will give Eli Lilly access to next-generation cancer treatment technologies, especially for things like blood-related cancers, myeloma. So keep an eye on Eli Lilly, big deal in biotech. Kelly, I'll send things back over to you.
Colonia. That's another good one, like Kellanova. Dom, thanks. Turning to Washington. We're counting down to Kevin Warsh's nomination hearing tomorrow morning, where he'll testify before the Senate Banking Committee. Among other topics, lawmakers may question his longtime ties to Silicon Valley and what that means for his approach to monetary policy. And last hour, we got a look at what Warsh will tell the committee. Steve Leisman is here with the details.
A lot of talk about that tech stuff there, but first, Fed Chair nominee Warsh will strike a note of optimism about the outlook for the U.S. economy in that Senate hearing tomorrow, while at the same time criticizing the very Federal Reserve he hopes to join. He calls this a time of great consequence for the economy, the most significant hinge point in a couple of generations, and says economic growth potential is rising. That optimism comes from his belief in the promise of artificial intelligence and technology, born of a strong background in tech investment and long-time relationships with leading tech investors like Peter Thiel, Mark Andreessen, and Jerry Yang, founder of Yahoo, along with Alex Karp of Palantir. Warsh's testimony also struck familiar themes of criticism of the central bank since he left as the Fed governor in 2011, including that it strayed into fiscal and social policies, had too big a balance sheet. He's going to say Fed independence is essential, but it's best achieved by achieving the dual mandates of stable prices and low unemployment. He adds that Fed independence is not threatened when elected officials state their views on rates, a reference to the president's consistent and often harsh criticism of the Fed and Fed Chair Jay Powell. I'm committed, he says, to ensuring that the conduct of monetary policy remains strictly independent. I am equally committed to working with the administration and Congress on non-monetary matters that are part of the Fed's remit. Finally, Warsh suggests he disagrees with the Fed's decision to fight a subpoena from the Justice Department in a criminal probe of Powell. He said the Fed officials are, quote, are not entitled to the same special deference in their stewardship of public monies as they are in the making of monetary policy. So some questions about how what actions Warsh would take to ensure the Fed's independence.
One point sort of stuck out to me, which was he said inflation, you can correct me, is always and everywhere like the central bank's problem to fight and to deal with. It was something to that effect.
Yeah.
And it sounds like he's really emphasizing that, and what that means for, how quickly he can lower rates this year, who knows?
You did not misparaphrase him. I wanted to get the exact language. I don't think I can get it, but let me just tell you that Kevin's idea, as I get it, is there's no excuses. If you had a pandemic, whatever, if you had a surge in government spending, I believe what he's saying is it's up to the Fed, given the cards that it's dealt, to play the hand, and the hand is that you can always deal low inflation. And there's no excuse, no matter what happens, the Fed's credibility. If you have a tariff issue, Well, the Fed has to abide that and make sure that it does not result in in higher inflation at the end of the day.
Right. But I don't know exactly how he would go about doing that, right? I mean, traditionally you'd say, well, just tighten policy. It's no big deal. But then it is an economic contraction. I mean, he might just say, and I don't want to speak for him, but might argue that some of those influences were transitory, and that therefore, you know, what is the phrase? On a long enough time horizon, inflation will go to 2%. It sounds a little bit like the argument we've heard last year and this year.
In 15 seconds, Kelly, you have just summarized Kevin's conundrum, which is that how does he deliver low rates to his boss, President Trump, and at the same time deal with the idea that inflation is above target, that you have this surge in oil prices, that you just went through another increase of inflation from tariffs. So this is going to be a difficult thing while he wants to incorporate into his thinking in a very strong way, and this is really important, this idea of this surge in productivity he sees coming from AI. So a lot of different things. Look, people say the Fed is in the box. I respond, the Fed is paid to be in the box. That's what it does. It's always in that position of what the right thing to do is, and Warsh is going to have his hands full and his brain full of all these
I think the phrase was that the Fed must take responsibility. So that's strongly worded. The Fed must take responsibility for inflation.
So if you get it wrong, it's your fault, no matter what happens.
Yep. Well, we're living through history. No,
we're always living through history.
Listen.
We just lived through history. We did it again.
Steve, thanks. Let's get to Angelica Peebles now for the CNBC News Update. Hi, Angelica.
Hey, Kelly. The U.S. will host G20 talks over price impacts on food and fertilizer due to the Iran war. That's according to Reuters. Fertilizer prices have jumped since the start of the war, as the Strait of Hormuz is a major route for fertilizer products. The talks will reportedly come in the next few weeks as the U.S. pushes for coordinated action from major economies. California's Attorney General is releasing documents today in the state's price-fixing case against Amazon, revealing Amazon's conversations with Target, Walmart, and other retailers. The Amazon spokesperson told CNBC in a statement that the AG's motion is an attempt to distract from the weakness of its case. The case was first announced in 2022 and is scheduled to go to trial in 2027. And the Boston Marathon has a new record holder. Defending champion John Courier crossed the finish line in an unofficial 2 hours, 1 minute, and 52 seconds earlier today. That's more than a minute faster than the race's previous best time, which was set in 2011. Kelly, back over to you.
Really hard to even fathom.
Can't imagine.
Congrats to him. Thanks, Angelica. Coming up, Tom Lee from Fundstrat is here with his roadmap for the S&P to hit 7,700 by year end. That's a 9% gain. He does warn there's one key factor investors are overlooking regarding the recent rally, and we'll tell you what it is next. Welcome back. Stocks are shrugging off renewed tensions with Iran and hovering just below record highs. My next guest sees more records ahead as one big catalyst may be getting ready to mobilize, which is retail. I thought retail investors already were mobilized. Fundstrat's head of research, Tom Lee, is here. He's a CNBC contributor. It's great to have you here, Tom. What do you see going on here?
Well, I think that investors got very cautious into the buildup of the war, and they were getting cautious because many stocks held by retail were getting hit. You know, the software stocks, and as that fell, we know there were record inflows into software, and of course the Mag 7 had been falling. So I think investors viewed the war and the start of the war as a time to take risk off the table, which was very different than what we saw a year ago when investors were buying into the tariff lows. And now I think that the downside tail risks have been removed for the war. Hedge funds have been early and they've been adding risk, and that we can confirm that from talking to our clients. And I think now it's retail investors that are now beginning to take money off the sidelines and buy stocks.
Maybe this is a psychological or a political question. I'm just curious if you have any insight as to why they would react differently to the Iran war versus not just tariffs, but anything else politically that's happened. I mean, buy the dips has become a well-known catchphrase. So it's surprising that they were, you think, kind of going the other way this time.
It is surprising. I was quite surprised because I would have assumed if someone asked me in 2026, a war is going to start, what will retail do? I would assume that they'd buy the dip. But in our surveys with our clients, we found that many maybe had policy puzzlement. You know, they didn't really know how big this war could become. You know, their biggest fear was gasoline spiking and we could get a recession or a depression, and a lot of economists warned of that. So I think it was difficult for investors to say, we can trust what the administration's doing because there were too many people warning about the tail risks of that.
Is it possible they're right? You know, I was in a store earlier today and the radio was on. I haven't heard the radio in a long time. And the DJ it was some kind of pop or kind of broad station. And he was saying, you know, another check on gasoline prices, and boy, aren't they high? And I thought, wow, that's the first time I've heard gasoline prices talked about in a non-business news context in a while. Is it possible that actually there is going to be a bigger impact here and the retail investors actually know that and maybe the pros are missing it?
I mean, anything's definitely possible. One thing that we were at Fundstrat were emphasizing is that inflation adjusted, even gasoline prices here aren't nearly the burden they were 5 years ago, 10 years ago, even at the 2008 peak. And the war is stimulating the economy, and we can see that in the earnings estimates and the ISM and even the jobs report. So I think the state of the consumer is one thing versus maybe how they might hear in a radio commercial or the surveys, but I do think the consumer is in better shape. So I think the retail investor will end up chasing this stock rally.
And you think as they do, that will power it higher?
Yes, but for the right fundamental reasons, because earnings estimates are higher. The U.S.'s relative position has really been strengthened by what's been exposed by supply chains through this war. And I think as the world investor looks for growth and they worry about growth in general, they're going to buy the U.S. stock market, which is a growth index.
We're going to talk in just a moment about international and whether, you know, you should, not that you have to choose, you can do both, but if you had to pick U.S. versus international, is it U.S.?
I'd still be overweighting U.S. because I think if you think about where innovation comes from, whether it's in tech, healthcare, or financial services or fintech, that's really U.S. companies. And I think there was an argument the U.S. PE should derate, but the war has exposed that the U.S. multiple should be going up.
Really? So that could be accounting. We could get both earnings and multiple expansion this year?
Yes, I think once we're through, this is still going to be a very tricky year because we have a new Fed chair coming in the market. It's going to test that Fed chair. But once we get through that subsequent turbulence, we are probably entering, an 18 to 24-month period that might be one of the best we've ever seen in our life.
We'll see. As we just said, living through history. Steve said we're always living through history. Maybe we'll get a chance for the new best period of our investing lives. Tom, thanks. Appreciate it. Tom Lee of Fundstrat. Coming up, the Pentagon may have blacklisted Anthropic, but that hasn't stopped one government agency from using its technology. We'll have those details when the exchange returns. Welcome back to The Exchange. A new report says the NSA is using Anthropic's Mythos model, despite the company being on the DoD blacklist. Kate Rooney has more in today's Tech Check. Hi, Kate.
Hi, Kelly. So Anthropic's technology appears to be critical to at least parts of the U.S. government, despite the Pentagon also at the same time saying that this company poses a major risk. Axios now reporting the NSA is among those using Anthropic's Mythos model. That agency and the company did decline to comment on this. Mythos, if you remember, just a couple weeks ago, it was released to about 40 companies and now some government agencies. It is just being used for cybersecurity out there. Anthropic tells us it does not plan to release this AI model to the broader public at this point. NSA notably is part of the Defense Department, which recently banned use of Anthropic software. It labeled it a supply chain risk. This was after a disagreement between the two parties about safety and usage restrictions. It really, at the time, was an unprecedented move. It is typically reserved for U.S. adversaries. And we did have on Friday a meeting between CEO of Anthropic, Dario Amodei. He was in D.C. meeting with Treasury Secretary Besson and White House Chief of Staff Susie Wiles. Both sides did call that meeting productive. Any government use of this tech, though, Kelly, does signal some thawing of the relationship in the face of this legal battle with the government. It does really come as a sigh of relief for Anthropic's investors that I've been talking to. They've been pretty worried about any sort of contagion risk from all of this government drama. And so far, it doesn't appear to have been an issue, at least when you look at the growth rate. Anthropic right now getting about 30% of all paid AI subscriptions, catching up to OpenAI. Still the market leader, which holds about 35% of market share. This is according to new Ramp data. Two sources, though, also telling me Anthropic has been fielding offers for equity investments that would, if they accepted it, value the company around $800 billion. But these sources also say the company is not raising capital right now. That is all the latest, Kelly, as these companies look to go public. Yeah.
Bring it on. Sooner the better, I think. Kate, thanks very much for now. Appreciate it. Kate Rooney. Coming up, international markets lagging the U.S. since the Iran war started. Is it a good time to get in? Our trader looks at the overseas trade that could play catch up. That's next. Welcome back. The MSCI All World Index has been lagging the U.S. since the war in Iran started nearly 2 months ago. Joining us for more is Tim Seymour, CIO of Seymour Asset Management and a CNBC contributor. Tim and
Kelly.
Tom, did you hear Tom a little bit earlier on? I set this up just for you. He said,
absolutely.
Okay.
Go ahead.
He said that he would now prefer U.S. stocks to international. If forced to choose, we can all buy all of them. That's fine. And he said because the U.S. has the innovation in tech, in fintech, in healthcare even, he thought the PE, which he said probably needed to re-rate in the U.S., might even now expand. So what does Tim say to Tom about that?
Tom, you can have both, and you're probably underweight international. And no, innovation, are you telling me Taiwan Semi, Samsung, Hynix, ASML, and XPI are not innovating? Are you telling me you can't get the same tech trade in other parts of the world, maybe at a cheaper market multiple? Companies with growing free cash flow, countries that trade at PEG ratios, so the price of the underlying of the forward 12-month forward PE to the earnings growth, it favors international. Now, buying cheap international equities has never been a reason to own it, but cycle-wise, I think you're in the early stage of where international markets are trading back. But I would push back on innovation. I would push back on fintech and AI are helping companies around the world become a lot more profitable and a lot more efficient.
Nice answer. If he were here, I would get him to respond back. I'm looking to see if he...
It's not fair.
Yeah.
Right.
I was also last week getting in a debate, Tim, about, not a debate, but trying to understand, and we've talked about this before, so maybe you can elaborate on it. Given what you've said about innovation, fine, it makes sense that Taiwan and Korea and all the places where that's happening and driven by AI, great. What about Europe? Is that a totally different story? Are we being a little unfair if we just say, well, they might not have innovation going for them, but they have defense, but they have, what is the narrative there?
Well, and right, we would say they trade over 20% cheap on a forward PE. The Euro Stoxx 50 trades at a 2.6% div yield, the S&P 1.1. But as we've talked about with deregulation trends, I think you can make an argument that there's innovation in Europe, and look at companies like Siemens, SAP. There's a defense and industrial argument, but I think there's also an argument that European companies are innovating. I'm not going to push back on American innovation. It's fantastic. It's the world's best. Why would we try to even argue against that, especially sitting here? But you can't tell me that the rest of the companies aren't using all of the leading edge technology that's available to them. And I do mean maybe even banks and industrial companies as well as some of those tech companies. So I just think part of what you're buying when you're buying a European trade is it is nice to not be chasing these valuations. It is nice to have fiscal spending. It is nice to have regulation and deregulation that's recognized. The European Union knows, and we've had this chat, so I won't lean in that hard here today.
Yeah.
I'll just tell you that I think it's about relative underperformance for a long time, and it's about valuations you can buy. But these are world-class companies that are competing on the same global stage with U.S. companies.
Final question. I think it's also a matter of how long we're talking about. For a trade, I think anyone can get on board. For a year, probably. But if you're talking about wanting to invest a portion of your assets, maybe it's a 529, or I don't know, something like that, in one or the other, or to what proportion one versus the other, and not have to check back in on it. I think that's where a lot of people would default to, well, it's just a little bit safer to go U.S.
I run an international ETF, IDVO, and you can buy a portfolio of great global companies that are, I think, very, high balance sheet companies. So that's the story here. You need to be diversified, and international companies offer a lot of the same growth and innovation trends as U.S.
All right, up to, was that 12% year to date? Not too shabby. Tim, thanks.
Thanks.
Appreciate it.
Bye.
Tim Seymour. That's it for us. Thank you for watching The Exchange. I'll join Brian Sullivan for Power Lunch after this quick break.
Stocks are down a touch, but overall investors still appear to be betting the U.S. and Iran can reach a deal as the clock ticks down to the end of the 2-week ceasefire tomorrow. We'll get a power lunch. What was supposed to be a cooling off period appears to be heating up. The U.S. firing and seizing an Iranian ship after Iran attacked other ships to Hormuz. In moments, you're going to hear exclusive insights from an oil tanker company operating there and around the world.
And stocks are barely budging even after tensions in the Middle East continue to escalate. We'll break down the key scenarios and tackle a critical question of who is really in charge in Iran right now. Plus, airline stocks are lower, with American the biggest loser. After the carrier dismissed the idea of merging with rival United, the pressures faced by the industry as jet fuel prices continue to climb.
All right, welcome everybody. We have got a packed hour ahead to kick off your week. But let us start, of course, with the latest in the Gulf region and whether ships are truly transiting through the strait. Your first guest runs one of the largest pure-play tanker companies in the world. He has ships all over the globe. Joining us now exclusively is Herbjorn Hansen. He is the founder, chair, and CEO of Nordic American Tankers. Herbjorn, thank you very much for joining us. Would one of your ships be able and willing safely today to go through the Strait of Hormuz?
Let me make this comment. Safety of the crew is the main concern. And in my judgment, there is no question that the Strait of Hormuz will be open. Will it take a few days? Will it take a week? Or maximum a month? And we feel very, very good about it because there is so much pressure building now that the Hormuz simply have to be open. And Iran and the US, they must come together, and they simply have to come together to ensure that the strait is open. China has now entered the scene, and they have said to the market, get it right.
But right now, Herbjorn, would one of your crew, one of your ships, your crew for the safety, are they able to go through the Strait of Hormuz?
Absolutely, but we need to have the go-ahead from IMO, an international UN organization. And as far as I understand, that is the only organization that has a direct contact with the authorities in Iran. And if IMO, the UN organization, say yes, then we can go ahead and transit the Hormuz. And we have ships, as you say, all around the world. And this question is not a big question commercially for us. It is a big question related to the safety of the crew. But in my judgment, there is no question Hormuz will be open sooner than later. And I have predicted that. And time will tell when it will happen. I expect it will happen soon.
Why is that, Herbjorn?
Because the two parties, they simply have to find an agreement, because the international pressure is so tough from all over the world that they cannot keep it locked. When you think about that, 20% of all the oil in the world is passing through the Strait of Hormuz. Therefore, both Iran and the US must comply with the international pressure that is building. And that pressure is much, much higher and larger than people seem to understand.
Well, that pressure seems to be bringing the Iranians maybe closer to the situation you've described. Although our expert last hour said he thought Iran might continue to try to use its influence in the Strait of Hormuz going forward. Is that possible, that even while one conflict, maybe winds down, could this flare up? And if so, does that give you any concern?
Well, I think Iran has a history of thousands of years, and America also has a long history, but the two parties simply have to agree. And we, as a company, we don't give advice to politicians because we are not involved in politics. But we provide for the crew and we provide for safety. And in my judgment, and time will tell if I'm right, in my judgment, there is no question it will be open. I have been in this situation before. In the early 70s, we had the same situation. And also at the time when the Suez Canal was closed, we had the same situation. And presently, the market for our ships and the rates we achieve, they are very, very strong rates.
And speaking of the Suez, your fleet is primarily composed of Suezmax-sized tankers. So
Suezmax
only that. So how much of your business has transformed in the last month, Bjorn, to the Red Sea and the new Saudi loading port of Yanbu? Do you still need the Strait of Hormuz like you used to 1 month ago?
I think the answer to your question is yes. Hormuz is an extremely important part. It is an international waterway, and in an international waterway, the rules must be for all waterways, and there is no jurisdictional possibility that the Strait of Hormuz can be closed. But in these circumstances, I fully appreciate that the parties agree. But in my judgment, there is no question that Iran and America, they will have to comply, and they will be subdued to the international pressure, which is now mounting, and which I see all over the place. I have no special intelligence except for the fact that I am concerned about the crew, and we communicate with our crew 24 hours a day.
The one special intelligence you would have outside of what the crew is actually seeing on the water, I would say on the ground, but on the water, is insurance. Would you be able to get insurance to take a ship through the Strait of Hormuz right now?
Absolutely. Insurance is no problem whatsoever. I have direct contact with the biggest marine insurance company in the world, and we are very well covered, and all insurance elements are firmly in place, no question.
Bjorn Hansen, Nordic American Tankers. Really important and insightful interview to kick off the program. Bjorn, really appreciate your time. Thank you very much.
Thank you for having me.
Thank you.
And turning to the markets, which are lower today, but we're coming off of Friday's record highs. As we mentioned, tensions between the U.S. and Iran escalated over the weekend. Traders are betting the two countries seemingly will reach a compromise. Here with more is Julian Emanuel, Senior Managing Director at Evercore, and Stephanie Link, Chief Investment Strategist and Portfolio Manager at Hightower. She's also a CNBC contributor. Julian, a striking rally off of the lows. Are there any caveats you would add to that?
Well, look, I mean, it says two things. Number one, as your previous guest just mentioned, the expectation is the Strait will open sometime this summer. Maybe it's days, maybe it's weeks, but that elevated energy prices are likely to fall to where you see the futures curve in July. But look, the other aspect is that the 13 days off of the March 30th low were among the most forceful 13 days worth of rally that we've seen since 1982. And frankly, the medium-term and longer-term picture from that kind of thrust is very positive, regardless of what happens in the near term.
Stephanie, you want to respond to that?
Yeah, I mean, I feel like it's deja vu, right? I mean, the Strait is open, the market goes up. The Strait is closed, the market goes down. So I do hope that your previous guest is right, that it will open. I hope it is sooner rather than later, because the longer this drags on, then that will eventually put pressure on the economy and the consumer. But right now, we're not seeing that. And to be honest with you, I'm actually surprised that we're not down more. Just what Julian just said. I mean, we're up 12% since the S&P is since March 30th, and the Nasdaq's up 15%. And the sentiment indicators, all of them, fear and greed, S&P oscillator, RSI, they're all extended. So I wouldn't be surprised to see a little push-pull here in the short term. However, what's encouraging is
we are seeing a broadening out in the markets. It's like 1 week the Mag 7 does well, but then the next week the industrial sector does well. The industrial metals are at all-time highs. Discretionary is picking up. I think that's very healthy, and I'm excited about that, and that's why I think you want to have a diversified portfolio. Whether we see a pause, whether we do pull back, I think that's when you want to buy. Kelly, you and I have talked about this. You want to buy when there's uncertainty. When there is certainty, we are going to be much higher, and you're going to miss a lot of the opportunities. And I'd say one last thing is that the banks, Pepsi, J.B. Hunt, all of them talked about how the consumer has been resilient. I mean, I lost count as to how many bank executives said the word resilient on the consumer. Credit quality is good. Loan growth is good. That's all very, very healthy. And then J.B. Hunt said that we're actually approaching an upcycle, which they're very conservative about. So I feel good. If we do see a bit of a pullback on a day-to-day noise, I think you want to be buying.
Yeah, Julie and I will see your stats and maybe raise you just a bit, because I love your work, by the way, and I frequently steal your stats. We in the media are very focused on like simple things, like January 1st, so year to date the market has done this. On a rolling 12-month period, so 1 year ago to today, the NASDAQ is up 50%. The S&P 500 is up 35%. It's actually one of the greatest rolling 12-month periods in recent market history. What do we make of that? I'm trying to understand who the buyers are.
So Brian, this is actually a tribute to the fact that the public has been the most resilient investor. Because if you took that 12-month and put it to 13-month, you would get the majority of the sell-off that we saw during the tariff tantrum last year. And so those statistics would look less good than they look now that that's dropped off. But the point here is that as it was last year when you had the volatility in and around April, same as this April, the public has been steadfast. They have been buyers, and based on what happened last year, institutions played catch up much more rapidly this time than driving the Brow.
To go back to that, Julie, and not to step on you, and I described it last week kind of as the Pavlovian response, right, where sort of you ring the bell and then you buy. And we have been trained the last number of years that whenever there is a dip, you buy. When the market goes down, you buy. I mean, it still holds true, and it's been true this time. Do you see any situation in the next couple of quarters or months or years where the situation will not be true? Because to your point, every time the market has gone down, the smart money is bought and the smart money has profited.
There's going to be a recession sometime in our lives. And at that time, that's when you're not going to want to buy the dip. It's economic cycles have not been repealed. They've changed with policy changes. They've changed with liquidity. There's almost $8 trillion in money market funds. But it will happen at some point. And, one will have to be more cautious about buying the dip. But for now, we think the structural bull market has further to go in 2026.
And Stephanie, I was going to, mention that you always want to be buying when there's more uncertainty. And, by the time the coast is clear, it's gotten away from you. Because I know you like to lean against stuff that is a little too popular, or look for those value opportunities. What do you do with the market now, the way that it's come rip-roaring back, if you were on the sidelines, to Tom Lee's point last hour, where he said he thinks a lot of retail investors actually got out of the market and might not be in it right now?
Yeah, and that just speaks to what I said earlier, that we are seeing a diversified rally. And on any given day, you could see one sector do well and another sector do poorly. So you try to buy the dips. That's our whole thing, right? We buy low, sell high. But I think, I was buying back in March. I'm still buying on bad days. But I think you want to own mission critical technology and software. That's Synopsys, that's ServiceNow. I like Marvell. I've been buying that for a while. I've been adding to some discretionary because I do think if the straits do open, oil's going to fall. Consumer discretion should do good. Target is kind of at a consensus, a not favorite. even after it's had a 30% move year to date, but it's still down 51% from 2021 levels. I like Dick's Sporting Goods. They are doing an amazing job turning around Foot Locker. And then the financials. I was adding to Morgan Stanley last week after their phenomenal quarter. I've not ever seen them put up a 27% ROTCE. And finally, you know I sold Chevron. I am watching SLB. They report this week. I really like that story, but that quarter is going to be ugly. And I think if it sells off, I'd be inclined to be adding to that.
Yes, the old Slumbers Day reports on this Friday. So, Julian Emanuel, back to 20% of the S&P 500 reporting their earnings this week. You love large cap tech. You're still confident, obviously, in that story. What do you want and need to hear from earnings and guidance this week to keep that bullish bias?
We want to see double beats. It's very important that these companies beat on both the earnings number and the revenue number, and we're confident that large cap tech, which has a history of doing so, will do so once again. In terms of guidance, you basically want to hear sort of the narrative that despite the macro uncertainties, the longer term picture, particularly as it relates to the AI adoption and build out cycle, is robust, and that no, credit is not a concern. And for us, the public is likely to re-engage in large cap tech. I think last week's tale of a company that was a shoe manufacturer, a sneaker manufacturer, putting AI on its name and seeing the stock go up 500% tells you that animal spirits with regard to technology are waiting to be expressed this summer.
All right. Thank you both. Appreciate it. I saw that in I think it was Yardeni too last night.
Well, you can't spell Julian, you can't spell Stephanie, you can't spell Brian
without
an AI. You can't spell Kelly.
Well, that's all you need.
What's your middle name? Don't answer.
Noreen.
Your middle name is Noreen?
Yes. I'm still getting a tease about
That's
it.
an RBI right there.
I definitely had to pass it on too. I share the teasing with my daughter. After the break, the Iran war enters a critical phase. Who's really in control in Tehran, and can any deal stick? We'll break down all the scenarios with Wolf Research's head of policy next.
All right, you just heard our guest from Nordic American Tankers. Time now for more original reporting and maybe real intel about what is happening in the Persian Gulf. And yes, the Strait of Hormuz, because we understand that many of the headlines have been confusing lately. One day there's a ceasefire, the market soars. The next day, there's some ships from Iran firing on other ships and headlines that the ceasefire is fragile. It's a complicated issue. But let's give you what my sources are telling me right now, and that is that there are multiple parties saying they are in control of Iran. The White House negotiating with one group, while another group, or groups, we don't know, likely led by the violent Revolutionary Guard, who control the weapons, by the way, and can assert that they, not the other group, are the ones in charge. Then, of course, that group, the violent one, they try to prove it by firing on ships. This is why you will often hear or read seemingly conflicting headlines, because the situation on the ground in Iran and maybe on the water is conflicted, and it may be for some time. Let's welcome in Tobin Marcus. He is head of policy at Wolf Research. He has a new note out today titled, "Everyone Wants a Deal, but at What Price?" And in it, he wrote about this very idea, saying, quote, "Can the Iranian regime as a whole be said to want a deal in coherent fashion if the IRGC, the Revolutionary Guard, is openly feuding with the political leadership running the diplomatic track? What if the factions in the regime all want a deal, but there is no consensus on strategy or concessions, and are negotiations viable while both sides are escalating?" These are excellent questions. Tobin Marcus of Wolf Research joining us now. Tobin, I've been reporting on this for more than a month, and I know some people are like, well, of course that's the case. It's not, because you read the papers, you read whatever, there's headlines about ceasefires. What are you hearing about the real state of leadership or lack thereof in Iran?
Yeah, Brian, thanks for having me. So look, it is clearly a complicated picture. There both is some fragmentation in the regime, and then the sourcing of the various people who are trying to report on it is similarly fragmented, as people are doing their best to get information out of a country that's in the middle of a war and under a bit of a media blackout as well. So, I mean, our thinking about this has been, since the selection of the younger Mojtaba Khamenei, as supreme leader, our interpretation of that decision was that it represented a consolidation of IRGC control. He was sort of the chosen candidate of the IRGC as we understood it, not somebody who had such singular force of personality or such deep networks himself that he was going to be a sort of singular leader astride the country the way that the two previous supreme leaders had been, but rather someone who sort of had the support of the security services. And so as we've been watching these negotiations, I certainly think there are differences of opinion about exactly what the acceptable price for a deal is, but I do think there is conceptual buy-in to the notion of seeking a deal, both from the civilian leadership and from the IRGC, or else I don't think that these negotiations would be happening. So, I think go ahead.
I was going to say, Tobin, your job in part is to connect the dots between what we just talked about, sort of the political landscape, and what it means for the stock market. So, with everything you've written about, what Kelly has talked about, what I've just reported and talked about, should investors be ready, be prepared for the fact that there may be headlines that are conflicting, confusing, and scary over the next days, weeks, and months?
Yeah, absolutely. The environment is going to be very noisy. I think our guiding thesis in the period since the ceasefire was announced was that it seems like everybody now is trying to find a way to end the war. You can look at the red lines substantively about what is or is not acceptable in a deal that are being laid out by both sides. They still look very mutually irreconcilable. President Trump is promising terms that are extremely favorable to America. The Iranians are asking for a very different set of parameters. But as long as everyone is at the table and they prefer diplomacy to hot war, that's probably going to be good enough to keep this on a positive trajectory such that the worst is behind us. But yeah, I mean, the headlines are going to be very noisy. There certainly is risk there. Any given round of talks could kind of fail to produce a great outcome in the room, as we saw last weekend with the first round of Islamabad talks.
There are some senators, I think Tillis is one of them, sort of threatening that if this goes 60 days, they might apply more pressure to constrain the president. I don't know if that's just politics.
Yeah, I have a hard time seeing Congress actually doing anything to meaningfully constrain the president using the authorities at their disposal, which are, on the one hand, cutting off funding for the war, right? Power of the purse is sort of their essential power here. And on the other hand, the War Powers Resolution, which as you alluded to, there's this 60-day clock after the initiation of a conflict where the president is supposed to start winding things down if they don't have congressional authorization. They have another 30 days to do that after we hit that 60-day mark, which is going to come up next week. So theoretically, we're at the point where President Trump needs congressional authorization, but we've never really seen that be binding in the past. And it's hard to see the Congress, as it's currently constituted, sort of unifying around any way to restrain the president here.
On a totally separate note, but speaking of Senator Tillis, how is this going to play out with his blocking so far of Warsh's nomination? I think those hearings are starting tomorrow.
Yeah, Warsh will be testifying tomorrow. We've encountered some confusion already about whether or not a vote is tomorrow. It will not be. A vote will happen once they figure out that they have the votes, which means clearing Tillis's objections out of the way. So I take him completely at his word. I mean, he's said he's not intending to ask Warsh any questions at that hearing because he has no concerns about Warsh's qualifications for the job. The only thing he wants to say is that this investigation into Powell needs to be wound down to satisfy his concerns about Fed independence before he's comfortable voting for anybody. And he alone can hold up the entire process. So I do think they're going to need to satisfy him. We'll hear from Warsh in the meantime. We'll be watching that closely for his views about monetary policy. But we're not going to be able to move the ball forward on the nomination until they can get Tillis back on side.
We've seen, a look at what Warsh is going to say tomorrow. And I believe as it regarded this question of the DOJ investigation, he said that the Fed should cooperate because questions of kind of the public purse were different than questions of monetary policy. What does that tell you?
Yeah, he took a bit of a gentle shot there without sort of getting too far offsides. Yeah, I mean, his prepared remarks were interesting. I think that one, read to me as being aimed at the audience of one. I think he needed to say something to align with President Trump there. I do also think he's sincere. Certainly, he's been a consistent advocate of the view that when it comes to cultural matters, the Fed sort of dalliances in green policy, that those are out of bounds and a sort of a misstep by the institution that undermines their public trust. So I think that's an authentic view, but not what he's going to want to focus on tomorrow.
Right. Although they rarely get to pick their focus, and now we hear, they're going to focus on his wealth and discrepancies, and that's what the Journal says anyway. So much more to come.
Democrats will be poking at him. We'll be watching for the more substantive exchanges. I was struck by there was definitely more focus on the inflation side of the mandate than the employment side of the mandate in those remarks, which was notable, and I think it reflects his authentic views.
Big shift from maybe the past decade or so. Tobin, thanks. Tobin Marcus, Wolf Research. On deck, another major twist in the ever-changing story around the Gulf. We'll tell you what it is and what it means for energy next. A major move from one of the world's top oil producers. Kuwait has halted crude shipments, declaring force majeure as the Strait of Hormuz disruption prevents tankers from entering the Persian Gulf, making it impossible to meet delivery obligations. So what does this mean for global oil supplies and oil prices, which are on the move higher again today? Joining us on set to discuss is Vikas Dwivedi, global energy strategist at Macquarie. Good to have you here.
Thanks for having me.
So is Kuwait declaring this because, look, as we understand it, the longer the Strait is effectively shut down, the more people are going to have to kind of shut in production because stuff can't come in, stuff can't leave. Yep. They've run out of storage capacity. So what's the next move now?
Yeah, the next move is really on the hands of the consumers to figure out ways to get oil that they're not getting from the Middle East. And this is also going to be a source of diversifying your imports, right? Because there was too much concentration risk in a lot of the consumers, where if something like this happened, they were going to be down and out pretty bad. It's taken a little while for a force majeure. We would have guessed it would have happened earlier, but here we are. And you know, Kuwait is unfortunate, unlike UAE, which has an outlet through their own pipeline. Saudi has a massive pipeline. Oman is just on the other side of the pinch point. Kuwait doesn't have any of those sort of options.
And who are their customers primarily?
Mostly Asia, still, just like most of the Middle East. So,
what I'm trying to understand, Vikas, and we all want to be optimistic about the outcome here, and I don't want my haters to be like, oh, you're so negative all the time. And the other half is I'm too positive. I have no idea. Anyway, the difference between the paper market and the physical market is shocking to me.
Absolutely, yeah.
And how we're at 86, 88 and change. We're not at 158 and change, despite the fact that, let's be clear, even if we see our buddy Herborn Hansen at the top of the show going full bore through the Strait tomorrow, it's going to take 4 to 6 weeks to get a semblance of normalcy.
Yeah.
Minimum.
Minimum. That's on the early side.
I'm trying to be optimistic.
Yeah, look, we're optimistic. We think it'll be sort of 2 to 3 months to normalize. And the feedback we get from our clients and a lot of the other market participants is irrationally optimistic. No chance. So 6 weeks would be even.
So why aren't we at $125 a barrel? I don't want to be there. I don't want to. I know what the damage it will do to families and gas prices, whatever. But trying to look at supply, demand, and disruptions and supply shocks, and the math sometimes is hard for me. But you know, I'm just a TV anchor.
No. Look, it's a great question, right? It should be higher, and by every mechanical and fundamental process of the market, it should be higher, the futures price. The physical price is reflecting that reality a lot better. But you know, when we think about crude oil, we think about you have a impulse, right? You have something that happened, and then you have a series of shock absorbers. The shock absorbers could be futures markets, it could be the shape of the curve, it can be the physical markets, like the internal derivatives paper that links the two together. Everything is doing the work, right, except for the actual futures contract. So that's where the shock absorber isn't working. And you know, as we've talked to a lot of our clients who are in it as well as we are, I mean, we trade physically, there's not an easy explanation as to why. There's a lot of theories.
What are the theories?
Well, the theories are that there's a lack of buyers, that it was already too front-loaded, so nobody wants to buy. A lot of the initial length got burned badly, so there's a reluctance. There's the risk, right, of headlines and both sides coming out and saying anything positive, and you know, oil falls $10 a barrel, so how do you manage that with any kind of sizing? There's conspiracy theories that there's other actors involved that are selling. You know, we know the Treasury Department said they're not selling.
Right.
A lot of people say, well, somebody is, and they're doing it very aggressively.
Who else could be selling? I mean, are we talking about other nation states, or could there just be other players in the energy markets who are seeing this opportunistically and saying, yeah, it's a great time to sell?
Yeah, it could be any of those. That's the problem with kind of narrowing down who it might be. If you're a large consumer, a large importer, and you have some balance sheet, this would be a good opportunity to use that balance sheet to keep futures low.
If we see peace, true peace, for a couple of months, again, being optimistic.
Yeah.
Are we at 65 a barrel? Are we back to 65?
Yeah, maybe not in a couple of months, but in short order. Yeah, the market is still vastly oversupplied. And I think that...
Not right now, but in a normal world.
Yeah, in a normalized world, we are oversupplied. And the narrative out there that there's been too much damage to the market, we disagree with. We think things will pop back to normal much faster. Maybe not as aggressively as your estimate of 6 weeks, but...
That's not my estimate. I'm trying to be optimistic.
Yeah, okay, but we're thinking more like 2 months, maybe 3, not... We've heard, CEOs and others in the industry say it could take a year. We disagree with that.
I've heard 2 years on the product side. Do you think there's going to be a bigger increase or effect on gasoline and diesel and jet fuel?
Products will take longer. Let's say oil takes 3 months. Products would take probably another 3 months on top. But 2 years is really catastrophic, and it doesn't fit the fact pattern that we certainly have.
Maybe with Qatar LNG, but not with oil.
Not with refined products, gasoline, diesel, jet fuel, et cetera. That won't take 2 years.
But it'll still be a ways from now, it sounds like.
Yeah. We can think about it as 6 months after all of this has kind of settled out.
Every day, though, new headlines. Vikas Trivedi, Macquarie Group Global Energy Strategist. Vikas, really appreciate you coming on set. I know you're based down there in Houston, so thanks for taking the trip all the way to Jersey for us.
Absolutely. Thanks for having me.
Just a reminder, folks, sign up for our energy-related newsletter called Power Insider, weekly piece into key news, meeting power players, and more. You can use that QR code. Sign up today. It will roll out every Wednesday. If the guy that writes it writes it.
Get to it.
Get to it.
Let me know. I'll help you. No.
Really?
Well,
I'm gonna take
if you give me any more chocolate, no. Coming up, merger talks grounded. American Airlines saying no to United, and we'll talk about what it means for the industry next. Shares of American Airlines are falling today, nearly 5%, after the company flatly rejected talks of a potential merger with United. Let's bring in our airline industry reporter, Phil LeBeau. Flatly rejected, Phil. What does that tell you?
tells me it was dead in the water from the beginning with American, and that's not a surprise. There's nobody within American Airlines, at least on the executive side. Now, there may be some employees, but at least on the executive side, there's nobody who think that this thing is going to go anywhere. At least that's the situation as of right now. So when you look at this idea of a merger between United and American, a couple of things to keep in mind. American making this letter very public late on Friday afternoon. It was well after the market closed, rejecting the merger idea with United Airlines. Meanwhile, you've got a couple of senators who are requesting details about any talks between American and United. Let's be clear here. There are no talks. United has not made a formal overture to American Airlines, so there's no talks. But if it happens, you've got a couple of senators who are saying, yeah, we're not crazy about this idea. Let us know what you think and what you're thinking in terms of discussions. And the Q1 earnings calls this week, that'll be the first time we hear from Scott Kirby and Robert Isom, because they're going to get a lot of questions on this. And while there may be, hey, well, we don't really have anything to talk about right now, it's out there. And so you will hear more than a few analysts talk about this. United reports its results after the bell tomorrow. Then Scott Kirby is on the analyst call on Wednesday morning. American Airlines reports its results on Thursday morning. And then shortly after that, you will hear Robert Isom on the American conference call. We should also point out, we're going to be talking with both of these CEOs over the next couple of days. And we've got a lot of airline CEOs lined up for results this week in terms of exclusive and first on interviews. Ben Minicucci tomorrow. We're going to be talking with him exclusive. We'll talk with Scott Kirby on Wednesday, and we'll talk with Robert Isom and Bob Jordan on Thursday as well. So lots of interviews, guys. The Kirby one is going to be interesting because it's out there, and I think he's going to have to address it in some fashion, whether or not he chooses to say, well, nothing formal to announce at this point. We'll have to wait and see.
Did you catch our discussion with Jonathan Cantor, Phil, where we were? He was arguing that the industry needs more regulation, and I was questioning where are all the profits if it's sort of an oligopoly. And maybe the answer is with the biggest players only, the only ones who have positive stock performance over the past 5 years. But I'd love to hear them all weigh in, all of these executives, on why it seems that kind of investors lose, the consumer is always mad, and regulators think that they, have too much power and can't combine. It feels like that. One of those things has to be wrong.
Kelly.
Yeah.
Consumers are going to complain, period, about airlines. It's a favorite topic for them to complain about. So I'm not saying they're not right sometimes, but they're always going to complain in some fashion. In terms of whether or not the airlines can be profitable, they can be profitable. Both United and Delta, they generate most of the profits within the airline industry. So it's not like these are companies that cannot be profitable.
But his argument was you shouldn't let a smaller player tie up with one of the bigger ones now. And I was wondering what, the alternative is if Spirit's going to go back. So I don't know if American over a 5-year period is struggling. I don't know if it is. It's probably putting it too strongly. I thought they had a lot of debt.
It's struggling.
Make sense. Yeah,
they're struggling to turn a profit here. With regard to Spirit, Kelly, one thing to keep in mind. That's the totally separate end of the industry, and it's a very, very small percentage of the seats in the United States. You never want to see an airline go out of business, but if Spirit were to go out of business and they're in bankruptcy right now, it's really, really small. Who would benefit the most? Likely the other low-cost carriers, though there might get some business that goes to the larger carriers. But you're talking about a different business model there relative to Delta, United, and American.
Sort of like we all agree that there's a problem, but what should be done? Anyway, I know we have to go, but for later this week, perhaps, Phil, as we hear from all of those CEOs, appreciate it.
Okay.
Phil LeBeau.
All right, let's get now to Christina Partsinevelos with a CNBC News update.
Brian, FBI Director Kash Patel today filed a lawsuit against The Atlantic seeking $250 million for what he claims is a defamatory article detailing his alleged abuse of alcohol. In response, The Atlantic said that it stands by its reporting and will vigorously defend against what it calls a meritless lawsuit. Talks have reportedly been extended between Caesars and billionaire Tillman Fertitta, for his proposed $18 billion takeover. That's according to Bloomberg. This executive, who is currently the ambassador to Italy, owns the Golden Nugget casino chain as well as Landry's restaurants and plans to combine them with Caesars to create an even bigger casino giant. And NASA may not have its new spacesuits ready for the lunar landing scheduled for 2028. The agency's inspector general warned today the suits being developed by Axiom Space may not be ready until 2031 if the company has similar delays to past spacesuit development. Axiom has yet to respond. Brian, it seems like these plans are hanging on by a thread.
I watched The Martian last night, by the way. Extremely good movie. One from Matt Damon 12 years ago. Worth a rewatch. Christina, thank you very much.
Thank you for sharing that.
You're very welcome. All right, coming up, from the Earth to the moon. Speaking of astronauts, USA Rare Earth surging more than 40% this month. It made a deal today. I'll tell you who and why next. Oh, we got a big story around the world of rare earth minerals. Shares of USA Rare Earths are popping. You're up 12% right now. Buying Brazilian rare earth miner Serra Verde in a deal worth $2.8 billion. The deal will give USA Rare Earth access to 4 critical minerals and help fight off China's dominance in the industry. CEO Barbara Humpton was on CNBC earlier today, and she talked about why this deal is important.
The world has become too dependent on a single source, and it's high time to break that dependency. A year ago, USA Rare Earth formed and has been through a journey of pulling together the best in the industry. This announcement of Serra Verde is brilliant because what it allows us to do is have access to a producing mine that produces the 4 magnetic rare earths that are going to be serving our industry.
USAR expects to complete the deal later on this year. Now, the stock is up today, but keep in mind it is still down by about half from its October highs. And just a reminder, as we've talked about for months, this company and some others in this rare earth space have yet to make any revenue, not earnings, any revenue, their pre-revenue, as it is known, just something to keep in mind.
And coming up, Quantum Leap. IonQ pacing for its best month in more than a year. It's a $47 stock now. And our next guest says there's still time to get in. It's power check time. We're looking under the radar for stocks you may want to pay attention to. And we'll start with IonQ, which is up 50%, 64 really, over the past month. Sylvia Jablonski is here. She's the CIO and co-founder of Defiance ETFs. Good to see you. We've got IonQ, Coherent, and Lumentum. We'll try to quickly get through all of them. IonQ is one where people, is it a story stock or is, are there real profitability there?
Well, there's real profitability there now, which is great. The company's finally revenue positive. They had massive growth last year. They're looking for 80% growth this year. And right now they have a backlog of $370 million in revenues, which is 3 times, what they're doing right now that hasn't come to fruition yet. So I think it's the idea that quantum computing is coming to fruition. There's a lot of investment in quantum computing from governments, different sectors like drugs, technology, defense, things like this, and it's a leader in the space.
All right, so you say, it's one you can kind of own and hold, I guess, if I can put words into your mouth. Coherent and Lumentum, this you're saying, we've had Lumentum CEO on a number of times. Yes. They kind of do the light. You say this is the next generation of AI infrastructure. You think there's upside in both of these?
I do. So I think just the general theme, photonics is huge, and these are the top 2 players in that theme. And going back to quantum, photonics pretty much feeds quantum computing, 6G connectivity, sensing, things like this. And so you have a problem, essentially. You need to move data through GPUs, and in order to do that, you have to have photonics or lasers to do it. So this is a critical aspect, a pick and shovel of AI. If AI grows, this has to exist. So hyperscalers are investing, CapEx is going there, and so the 2 companies, you have Coherent, $5 billion plus last year, 35% margins. You have Lumentum, which is $533 million. They had 58% year-over-year growth over the quarter, and they're very much leaders in this space, and they're needed to move AI forward and solve this electrical connectivity problem.
Yeah, so these are areas where, as to put Gene Munster's kind of quote him from last hour, he said, yes, Iran matters, but he said the AI trade matters more. I mean, I guess that's self-evident looking at the behavior of some of these stocks and the whole market right now.
It is, and if you just see what's happening and who's getting into these plays, you're talking about NVIDIA, right? $2 billion of investment in both Coherent and Lumentum separately, and now the announcement of Ising, which is essentially working through error fixing, let's call it, for quantum computing. So you see everything that is going to be needed to build out AI, and the largest players are investing in these different spaces, and they're not overcrowded yet.
Just to kind of put you on the spot, because you're here and why not, do you have any concern about the speed with which we've come off the lows and just the fact that here we are, we're basically, even with today's slight declines, we're basically back at record highs?
Yeah, we're back at record highs, and I think that's the backdrop of the economy. The economy's good. We're looking for double digit, about 14%, I think is where we're trending for earnings right now. These companies are delivering. Yes, CapEx spending is high. We have to see how that monetizes, but consumer spending, sentiment's good, markets are steady. I do think a lot depends on geopolitics, though. Where that goes will determine essentially where the market is and the type of volatility that we'll see in days to come.
All right, Sylvia, great to have you here. Thanks.
Thank you.
Appreciate it. Sylvia Jablonski with Defiance ETFs.
All right, folks, big day. We'll see what happens in the final hour. Thanks a lot for watching Power Lunch.
Closing bell starts right now.
Welcome to Closing Bell. I'm Leslie Picker in for Scott Wapner. Today we are live from Post 9 at the New York Stock Exchange. Stocks preparing to snap their 13-day winning streak. Tensions escalating between the U.S. and Iran. However, investors are betting the 2 countries will reach a compromise. Here's a look at the scorecard with 60 to go in regulation. The Dow is down about 0.1%, the S&P down 0.3%, the NASDAQ down by about the same magnitude. Take a look at oil. Crude surging following the latest developments out of Iran. WTI up about 6%, ICE Brent up about 5.6%, and software bouncing once again today, up about 1.1 on the IGV, with Adobe moving higher after announcing the launch of its new AI agent platform. We'll take you live to the company's summit in Las Vegas. And Fed Chair nominee Kevin Warsh testifying before the Senate Banking Committee tomorrow morning. We'll have a report on what he's preparing to say about future Fed independence and more in just a moment. And that, of course, takes us to the talk of the tape. Is the market taking a quick breather, or is something bubbling beneath the surface? Let's ask our panel. Solus Dan Greenhouse, JP Morgan Private Bank's Abby Yoder, and Wealth Enhancement Group's Ayako Yoshioka are all here today for the panel. Dan, let's start with you. I know you have kind of urged investors to ignore the puts and takes of the various geopolitical conflict on a daily basis. How risky is it, though, to do that? I mean, especially given just the overall tail risk environment and so many unknowns out there.
Well, I guess based on the fact that the market is now higher than when the war started, I'll say not very risky. But the point about I was talking about it, that sometimes the best thing to do is nothing, which is sort of how I described it over the last couple of weeks, is this is really difficult to trade. You don't, on any given day, the strait is open, it's closed, ships are being taken, they're not, they're getting through. It's just impossible to ascertain exactly where we are at any given moment. And so the best thing to do is just to look through it. Now, here we are, obviously, a couple of weeks later, we find ourselves, the stock market's up, call it 2-3% above pre-Iran levels. Obviously, interest rates are a bit higher, call it 25 basis points higher. Oil about $20 higher. So there's a bit of a disconnect on that front. But again, from an investor standpoint, at this point, you probably have to look through a lot of this, seeing as how the worst case outcomes, which is like a regional war that was really going to destabilize the world, seems to be a much lower probability now than even 2 or 3 weeks ago.
Do you feel like being able to look through it is something that's just a possible in the short term, but the longer this goes on, the more of an impact to the supply chain we see with oil, that maybe over the long term, it is something that investors need to be paying closer attention to?
To be clear, that's absolutely true. So the problem that I've expressed, and there's a lot of optimism espoused by a number of people who come on the network and invest, that those worst case outcomes don't come to pass. I think the problem that the guys and the girls who are in the oil market more specifically, and as I've said repeatedly, Solis has spent a good amount of time investing in energy and energy-related names. The math really starts mathing against you in the not too distant future. And what I mean by that is, we went into this with an oversupplied market on the order of, call it 2 million barrels. Inventories were very high. Oil on water was abundant. And so there was a bit of a cushion there to ameliorate the worst effects of a closing of the Strait of Hormuz. We've worked down inventories considerably. Oil on water is basically non-existent. Yes, you have some alternative pipelines to Fujairah across Saudi Arabia down to the Strait over there. So there's things you can do to ameliorate this, but inventories can't go to zero. Pipelines can't be shut down. At some point, supply-demand means prices are going to have to go up. I don't know whether that's today, tomorrow, or the next day, but unless you get that strait open, the hundreds of millions of barrels of oil that are shut in are probably going to start to show up in the form of higher prices.
Abby, from the demand side, do you think we get to the point where there is real demand destruction for the level of oil, the level of gas? I mean, $4 gas, there was a point in time where that was a real big shock. Obviously, we've had significant inflation, since that period of time. $4, it seems like consumers are so far weathering it okay. They're taking, spending away from certain other areas to compensate perhaps, but not necessarily recessionary quite yet.
No, not at all. I would say important in that backdrop is that you also have tax refunds that are up, 15% year over year. And so that's creating a windfall for, the consumer in terms of gas spend. And if you look to what, the bank said last week in terms of their results for earnings, it was very much that the consumer is still strong, right? Like spending volumes are mid-single digits, 6%. There's still that K-shaped economy that's happening in the sense that, the high-end consumer is continuing to propel that spend. But for the most part, I mean, everything that we heard last week in terms of earnings is fundamentals remain strong. So to Dan's point, if you did do nothing, that was the right call, right? And that really is why the market moved as quickly as it did, right? Positioning got really offsides because of the geopolitical events, but underneath, like if you really look at what was happening with earnings revisions, they were positive, right? So if you have any indication that this war might end sooner rather than later, then you want to get back involved in the market, and that's exactly what happened.
Yeah, and to your point about oil, B of A had a chart in its earnings which showed the spend, and it showed that yes, the spending on gas ticked up from about 3% of someone's wallet to 4%. It was a 16% increase during the month of March, which is a lot, but it's still such a small proportion of their total wallet spend over the course of that month. So that brings us to Aya. You do think that we could see some slowing in overall growth. Is that driven, you think, ultimately by oil prices or something else?
Sure. I think from, just the overall increase in costs related to energy costs going higher, it's going to dampen overall growth. But we do think that's going to be offset to a certain degree by all of the growth that we're seeing in technology and AI related names. And I think that's what the market's really reflecting just with this recent run up.
I want to turn to some sector specifics. Aya, you have been focused on earnings season and kind of what you've seen so far. We've had, numbers from the banks and some other sectors. Do you feel like the fundamental growth story as it pertains to earnings is in pretty good shape right now?
Absolutely, and we've really seen that with the earnings revisions that Abby mentioned. And we do think that we're going to continue to see this mid-teens type of earnings growth for the S&P 500 companies, at least in 2026. And that might be revised back down just again because of higher energy costs as this sort of prolongs, to Dan's point. But for the most part, it's such a small portion in terms of the overall costs related to, everything else in terms of the revenue growth that we're going to be seeing from AI and tech companies as well as industrials. We've continued to see strong earnings revisions